headquarters off of Crimea back to someplace safer. And with a lot of maritime drones and help from the West, they really run the Black Sea. So this is very much an advantage for Russia. If Ukraine would agree to stop, shooting down Russian helicopters over the Black Sea and all that they've been able to do with a lot of help from their friends in the West.
Not to mention attacking that bridge to Crimea. We're spending time here with the doctor and some news that I didn't think we'd be talking about here with Rebecca Grant. The president just took to Truth Social talking about the Houthis in Yemen. We're just reading this together for the first time. Reports are coming in that while Iran has lessened its intensity on military equipment and general support to the Houthis, they are still sending large levels of supplies. The president writes, Iran must stop the sending of these supplies immediately. Let the Houthis fight it out themselves, he says. Either way, they lose, but this way they lose quickly. Tremendous damage inflicted upon the Houthi barbarians, he writes, and watch how it will get progressively worse. It's not even a fair fight, never will be. They will be completely annihilated, exclamation point. Now, just yesterday, he said that anything fired by the Houthis, we're going to treat like it was fired by Iran. What are we in for here?
Well, that tells me that the USS Harry S. Truman, our aircraft carrier in the region, is loading ordnance, possibly to do additional strikes. We know Central Command has more targets available. And Trump has said all along that this campaign can go on as long as necessary. But there's another message here, because Iran supports the Houthis, but so does Russia. We know there has been Russian intelligence used by the Houthis to target our U.S. Navy ships and global shipping traffic. So don't forget, the Houthi message goes to Iran, but it also goes to Putin.
This is huge. This had to have come up yesterday. And now you start, when you crack the door on something like that, you remind us of how much we do not know about what happened in that conversation, how many layers we're talking about here, how one deal can lead to another, the triangulation that the White House might be involved in. What does this mean for a potential attack against Iran?
Well, it means that I think we should see possibly more strikes against the Houthis. And I'd like to see them debilitated. We've done it to Hamas, to Hezbollah, but against the Houthis at first. Now, do Iranian targets become legit? There was an Iranian ship that sits in the Red Sea giving targeting information. Is that a legitimate military target? Maybe. What about their oil terminal down in the south? I think it's possible that we might see something, but I would expect to see first a step up against some of the Houthi legitimate military targets.
Okay. I can't imagine that that's a terribly tall order for our military, our Navy and Air Force conducting those strikes. What happens if you sink a ship flying under an Iranian flag?
Well, interesting question. If it's a legitimate Iranian military target, then, that's probably within the rules of the road. Well, if they're assisting in strikes, legit target.
You know what people say, though, is we're starting to talk about World War III. This is what we have always learned growing up. If you attack Iran, what are you unleashing? Or did we learn better when Iran tried to strike Israel last year?
Well, and I think the other thing we've learned is we can't appease Iran, and we know that we can defend against what Iran sends out.
Getting back to where we started, we've gone a little bit far afield here, and that is, of course, the call today with Trump and Zelensky. What's the next move? Is it a Trump-Putin meeting? Is it all three of these people talking?
Right. Next move is back to Saudi Arabia. I think Steve Witkoff will be going to that. And hey, the real news out of that call is it took place. And Trump was happy. What a change from the Oval Office meeting before, right? And so the main purpose of this call would have been for Trump and his team, Rubio and Waltz, to back brief Zelensky on what was discussed with Putin, choosing what items to talk about, and then seeing where Zelensky stands.
We only have a minute left with Rebecca Grant. What is the one thing that Ukraine could do to inflict the most pain against Russia right now?
Oh, well, to continue holding out in the Kursk region is certainly painful for Putin. He visited himself, and Putin hates it when they attack the Kerch Bridge. I don't know what their plans are, but
it's Kursk.
Yes, except for the Kerch Strait down by the Sea of Azov. But the number one thing is for Ukraine to remain sovereign, to remain close to the West, and to be a viable country going forward. Putin's going to hate that.
Wow. Well, those are very much in doubt at the moment. I guess we'll see where we are. Would you come back to talk to us again soon?
Anytime.
It's really great to spend time with you here on Bloomberg. Dr. Rebecca Grant. Of course, Lexington Institute, as I mentioned, here on Bloomberg. I'm Joe Matthew in Washington, the fastest show in politics, with our political panel next. Stay with us here on the radio and on YouTube. Search Bloomberg Business News Live. We'll have a lot more ahead.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks higher across the board. Fed Wednesday, a lot of green on the screen now, with the S&P up 41, gain there of 0.7%. Stocks pushing higher, with the S&P at 56.55, the Dow up 259 right now, up by about 0.6%. Nasdaq Composite Index up 1%, up 167 points. The 10-year at 4.30%, the 2-year 4.07%. Spot gold, little change to $3,034 the ounce, up 5 cents right now. West Texas Intermediate crude up 0.6%. WTI 67.29 a barrel, and Bitcoin up 3%, 84,530 on Bitcoin. The Mortgage Bankers Association this morning reported loan rates are up for the first time since January. And with that story, here's Bloomberg's Vinny Del Giudice.
Last week's rate on a 30-year fixed mortgage rose to 6.72%, causing a pullback in loan refinancing and tempering home sales. Total loan applications were down for a second week. Mortgage rates typically move in tandem with the U.S. Treasury's benchmark 10-year note. Looking ahead, there's more housing data set for Thursday, last month's tally of sales of previously owned homes. Vinny Del Giudice, Bloomberg Radio.
Sources tell Bloomberg Elon Musk's social network X has raised close to $1 billion in new equity from investors in a deal that values the company at roughly $32 billion, a valuation in line with when Musk took it private in 2022. After earnings, Signet Jewelers, that's the parent of Kay Jewelers, surging 18%. After earnings, Williams-Sonoma, the retailer, up by down 6.7%. Again, recapping, stocks higher, S&P up 42 points, up 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Fed Wednesday, Balance of Power continues. Your host here is Joe Matthew.
Keeping us trained on Bloomberg's top story today, Fed Day, yes indeed, about 45 minutes from now. Thank you, Charlie. We'll start our special coverage across all of our platforms, Bloomberg Radio, of course, our global television audience on YouTube as well, where you can find us right now. You may as well get in there. We've got a lot to talk about. Search Bloomberg Business News Live. As I say, 1:30 p.m. we'll turn our attention to our special Fed coverage with an important announcement at 2 p.m., and we'll bring you the news conference as well. Until then, we're talking geopolitics largely today in Washington because President Trump did hold a call earlier with President Zelensky, this following, of course, yesterday's call with Vladimir Putin, which lasted a lot longer, and the president had a lot nicer things to say than he did after this one. Though he did call it a very good telephone call, not a perfect call with President Zelensky, which he has a history of. Lasted approximately an hour, he says. Strangely, he writes that Secretary of State Marco Rubio and National Security Advisor Michael Waltz will give an accurate description of the points discussed. We're still waiting for those. And there will be a readout, presumably a statement at some point. President says will be put out shortly. We did hear some comments from President Zelensky saying that he is open to the idea of this partial energy infrastructure ceasefire, even though Russia bombed Kyiv all night. 145 drones, more than 70 missiles. And there were attacks across the nation here because there is no real ceasefire as we speak. One of the other big stories we're following here, the legal answer to some of the Trump agenda. There have been a series of setbacks this week, remembering that the White House has continued to say, and Trump has said it himself, did so last night on Fox, Caroline Leavitt as well, we will always obey the courts, and we will enjoy our opportunity to appeal. This follows news that Elon Musk has been found to have, in multiple ways, violated the Constitution. Much of this has to do with the actions that he took at USAID, and a ruling here by Judge Theodore Chang of the U.S. District Court for the District of Maryland, the first time a judge has moved to rein in Elon Musk and his Department of Government Efficiency directly. The president talked about it on Fox last night. Listen.
I never did defy a court order.
And you wouldn't in the future?
No, you can't do that. However, we have bad judges. We have very bad judges.
Reminding us of a whole different court order, remember, to turn the plane around when a group of alleged Venezuelan gang members was flown out of the country to El Salvador. judge said turn the plane around. The White House didn't do it because they say the plane was over international waters and they were under no obligation to do so. There's another one. We can put a third log on the fire here. Trump transgender troop ban blocked by judge during suit. This is another federal judge here, temporary blocking the president's EO banning transgender people from the armed forces. So that's what we're at today. And of course, the Doge is still busy doing a lot of other work, shutting down, for instance, the Department of Education. We've seen probationary workers who were fired reinstated. And we wonder what direction we're going in here with our political panel. Maura Gillespie is with us, Blue Stack Strategies founder, our Republican strategist, alongside Democratic strategist Roger Fisk, former special advisor to President Obama. Great to have you both here. Maura, what's going on? Because there have been a lot of questions about Congress kind of losing its teeth as a check against the executive. The courts have been awfully busy. Who's winning?
You know, when Elon Musk and the president came out with this idea about Doge, I think there was optimism about what the recommendations would be based on the investigations and Elon Musk and his team looking into the various departments and advising. But unfortunately, what has happened before many of these cabinet secretaries got in place, Elon Musk was making cuts and saying that the president was in lockstep with him about making these cuts. But what he did was take funding away that was already been allocated by Congress, which again is stepping on Congress's toes and on the Constitution's separation of powers. And so what you're seeing, unfortunately, is a real lack of messaging, but also directive and clarity from the administration. And with what's happening in Congress, they're really not saying very much. So what's coming back to the American people is a lot of chaos, a lot of confusion, and grocery prices remaining very high. So I think some of the things that people had voted for the president on during the election are not being addressed because there's a lot of other noise going on that's detracting them from the initial reason for their big win in November.
Roger, it's great to have you back. What do you make of the Trump White House beating the drum on its acknowledgement of the courts? We always do what the court says, and then we appeal. It seems to be part of the strategy. You just keep throwing stuff at the wall, do what the court says, so you don't get into trouble, and at some point, some of these things are going to stick.
Absolutely, Joe. Thanks so much for having me, and it's great to be here with Maura. I think they got a little bit of a unicorn this weekend, which is it happened over a weekend, first off. They've allowed it to kind of devolve into the courts needing to get into the forensics of when planes took off and when they left U.S. airspace and all these other things. And Judge Boasberg has been very clear in saying that it's not about the plane, it's about the U.S. personnel on the ground who were on U.S. soil for the entirety of this episode, not following clear orders. I think they're going to continue to do this kind of air war and ground war thing, which is the president in an atmospheric sense is going to say, we will, of course, always respect the orders of the court. But in an operational sense, the message, I think, is going to be very clear, just take off, just keep going, and we'll deal with it. But then, as we all know, because sooner or later these dynamics get captured in some kind of compelling video, a mother being taken out of her home or any number of other things that are going to bring it into stark relief. And when the people, when the American people see kind of this distilled into just the human essence, and you put it up against the kind of constitutional drift of the administration right now, that could change things very quickly.
Well, this flight or flights, we actually don't know if there were multiple airplanes, from what I understand, with these alleged Venezuelan gang members providing great political optics for Donald Trump. You see all these bad dudes shackled, and you heard a lot of applause, actually, by Trump supporters around the country. Caroline Leavitt was boasting about it in the White House press briefing and probably will again today. That's one thing, Maura. The ruling on the dismantling of USAID is another. And you start wondering here with the reinstatement of tens of thousands of probationary federal workers. Is the Doge going to survive the courts?
Well, I think that's to be seen. You know, what I had always kind of envisioned, I think, you know, when you look at what Doge is trying to do, there are plenty of areas where we have fraud, waste, and abuse. And identifying those issues is really important. And I think what a lot of Americans agree on. What we don't necessarily understand is the blanket, you know, cutting of programs, blanket cutting of an entire agency, rather than trying to restructure things or make them work more efficiently, make them work better. The USAID is a wonderful diplomacy tool, And without it, we leave ourselves and we leave the world open to this vacuum of leadership where China is already stepping up to do so. I spent time over in Jordan and Lebanon and visited Syrian refugee camps, and the Chinese flag and China, brought to you by China, is all over backpacks for young people there. They are flaunting it and shoving it in their faces that they are there for them. And with this departure from USAID funding, it leaves them to say, well, the West left you, but here we are. And so I think they could have used it as a diplomacy tool, maybe put it underneath the State Department's reign and kind of oversight. But unfortunately, they went with cuts, and then now they have to kind of backtrack.
Roger, the line from the White House, and Donald Trump's got a whole list of outrageous programs, outrageous spending line items that had to do with drag shows and comic books and different things in different countries. Is there, in fact, a need to reform spending at USAID? Can both be true at once?
Absolutely, and the Constitution lays out exactly where that responsibility lies, which is in Congress. There's no executive make-believe do-over after Congress approves spending on these programs. So the very place where this needs to happen, where it's appropriate for this to happen, is the same branch of government that the president and Mr. Musk have essentially hollowed out. Any kind of concerns about, I agree with them on fraud and abuse. Waste, to me, of the trifecta there seems to be a very flexible category. Waste is starting to, I think, mean anything that they philosophically disagree with. So very often when they say we've dismantled this program or that program, mosquito nets or vaccines, it wasn't because it was waste. It's their chosen euphemism for saying this was a policy that we don't agree with. But if the House Oversight Committee was pulling in any of these program managers and doing a full, sober, robust policy exercise and drilling into it and getting into the spreadsheets of the finances and the KPIs and et cetera, that would be one thing. But as we all know, that's not happening, which means this is largely just Mr. Musk and his minions going in and conducting somewhat of a blind kind of binary experiment where they just go up or down on a bunch of functions, which very often, as we've already seen, they don't even know what some of these departments or these individuals do.
Well, there won't be any drag shows happening in Peru on behalf of USAID, and there won't be any at the Kennedy Center either. Apparently, the drag brunch is canceled, Roger. President Trump paid a visit to the Kennedy Center this week. Has been in the crosshairs since he got into town here. He's taken over the board. He's, in fact, now chairing the board and stopped by for a tour. Suggested the facility was in great disrepair and promised to bring back the hits, the Broadway hits like Phantom of the Opera, as opposed to Hamilton, which, by the way, he does not like. Then there's the Kennedy Center Honors. You watch this every year, right? It's one of the coolest things happening in Washington. Trump does not like the show. In fact, he said in audio obtained by the New York Times, quote, "I didn't like it, I couldn't watch it, and the host was always terrible," unquote. Knowing, of course, that hosts have frequently criticized, well, at least at times, Donald Trump. So he has an idea. This, again, is part of his story. He's talking to other board members or the members of this board at the Kennedy Center as they're walking around. He's floating ideas. Who the heck would host this show? Who would host it if it weren't some of these folks we've seen before? I think Queen Latifah did one recently here, and then it hit him. What if he were to host the Kennedy Center Honors? Listen.
I will agree for Zero to be the host. I don't want to do it. I have enough publicity. They'll say, Trump wants to be the host. I don't want to. But I want this thing to be successful. And Maria, I think you would say, Laura, you would say, let's see, I'm going very quick. The king of ratings, right? Whether we like it or not, that king of ratings.
The king of ratings, Roger Fisk. Don't make him do it, but he's ready for the job. Will you start the drafting of Donald Trump Kennedy Center Honors?
I don't think there needs to be any drafting. He'll just wake up one day and decide it. And then from there, it's only just a hop, skip, and a jump to a fundamental name change. I can only think that at some point he flew over it and said, "What's that?" and thought to himself, "Wouldn't that be a great hotel location or something?" Because this will be the death knell of this, and in a couple of years, it'll be coated in gold, and then soon after that, it'll atrophy. And then the question is can the next administration actually revive it?
The fact of the matter is, Maura Gillespie, you're saved by the bell. I don't have to. The fact of the matter is, it will have amazing ratings, and that is the way this is going to end up going down. He's going to host it, right? They're going to have the biggest ratings of all time because no one will be able to stay home or not watch, at least. Our panel will be back with us in our second hour as we welcome our global television audience to the conversation. The call is over. It's next on Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
President Zelensky warms up to the idea of a partial ceasefire. Welcome to the fastest show in politics. As Zelensky speaks to President Trump today for the first time since their Oval Office meeting, We're just now getting some of the first details of their call. I'm Joe Matthew alongside Kaylee Lyons in Washington. Thanks for joining us on the Wednesday edition of Balance of Power. One thing we do know, Kaylee, as we wait for an official readout from the White House, is Russia continued bombing Ukraine heavily overnight.
Although our colleagues on Bloomberg Surveillance asked President Trump's special envoy, Steve Witkoff, about that this morning, he suggested that while Putin had agreed to the terms of this energy and infrastructure ceasefire, it had not yet been able to be conveyed to all of Russian forces. Unclear whether or not it was just a delay in communication that has actually happened here, but it is important as we consider what it takes to actually have an effective ceasefire. You need both sides to agree to the terms. And Russia and Trump made an agreement yesterday, and it does seem, at least according to sources familiar, that President Zelensky has signed on.
That's right. We'll have a little bit more for you on this, as I mentioned, when we get an official readout from the White House. The president did post on Truth Social at the conclusion of the call. Kaylee, it lasted about an hour. Curiously, he pointed to Marco Rubio and Michael Waltz as the two individuals who would clarify what was discussed, making us wonder if Donald Trump was actually personally in conversation with Zelensky or just on the line.
Yeah, also remarkable to consider how unemotive his Truth Social post really was.
That's
quite matter of fact, not some of the usual exclamations or punctuation we would expect to see from President Trump. So we're awaiting more detail. And I would point out as well, the White House press secretary, Caroline Leavitt, is expected to brief the press at this hour. So we could very well get some headlines out of that. But also, we're expecting headlines an hour from now. It'll be the Fed rate decision. They're expected to stay on hold, but we do get the dot plot. It's a lot for the markets to look forward to, and Charlie Pellet is tracking how they're trading ahead of it. Charlie, how are we looking up in New York?
Right now, we are higher across the board. We got you completely covered on the Fed right here on Bloomberg Television and Radio. Stocks higher ahead of that as traders brace for the Fed's rate decision and outlook. 2 o'clock Wall Street time. When it all comes down, our coverage begins 1:30 Wall Street time. And right now we have got the Dow, the S&P, NASDAQ solidly in the green. I'll throw in the NASDAQ 100 index and the Russell 2000 as well. S&P up 42, 56, up by about 0.7%. The Dow up 245, up by about 0.6%. The NASDAQ now higher by 174, up by 1%. The NASDAQ 100 index up 0.9%. And the Russell 2000 index of small cap shares up by 0.9%. 10-year 4.30%, the 2-year 4.08%. Gold lower little change, down under 0.1% right now. Spot gold 30.32 the ounce, holding close to a record. West Texas Intermediate crude up 1%, 67.55, and Bitcoin now up 3.1%, 84,577 on Bitcoin. Stock analysts at Cantor Fitzgerald, the firm long led by now Commerce Secretary Howard Lutnick, have upgraded their rating on Tesla, the car maker run by White House advisor Elon Musk. Tesla shares up now by 4.2%. Abu Dhabi briefly forming a $25 billion U.S. energy venture to power artificial intelligence. Recapping Fed Wednesday, S&P up 38, up 0.7%. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Fed Wednesday indeed, and as we await that decision, of course, we're also occupied with other happenings on this Wednesday, including the conversation that lasted about an hour between President Trump and President Zelensky, or at the very least between the Trump White House and President Zelensky. To the point Joe was making earlier, it's not clear exactly what this dialogue actually looked like or sounded like, and who was doing the predominant portion of the speaking, as it's the Secretary of State Marco Rubio and the National Security Advisor Mike Waltz who have been dispatched by President Trump to provide the actual details on this discussion.
That's what he says in the Truth Post as we wait for an official readout. Interesting language. It says, quote, just completed a very good phone call with President Zelensky of Ukraine. There's no I, there's no we. And later says, we are very much on track, suggesting that the peace deal is in the offing. And I will ask Secretary of State Marco Rubio, National Security Advisor Michael Waltz, to give an accurate description of the points discussed. The statement will be put out shortly, and then we got some headlines. President Zelensky is apparently open to this idea of a partial ceasefire.
At least according to sources familiar with the discussions who Bloomberg has spoken with. We haven't gotten a statement from President Zelensky on this either.
Technically not from either side of this phone call, just the Truth Post, and that's where we start right now with Courtney McBride from our national security team with us here at the table. What do you make of the language, the style of the statement, the length of the call? Do we even know if Donald Trump spoke directly with Zelensky?
We don't know yet. I mean, I think you two really hit the nail on the head. This is a little bit of a different style of message than we've seen previously from the president. But, you know, it's not unusual to wait for the White House official readout. Yeah. And certainly the Secretary of State and the National Security Advisor have previously been dispatched to Saudi Arabia and other places, you know, to negotiate the finer details of potentially a ceasefire between Russia and Ukraine.
Well, and the implication from President Trump yesterday was that they or others who will be negotiating parties will be dispatched back to the Middle East in short order to continue conversations on a wider ceasefire that goes beyond just energy and infrastructure. Do we have a sense of how quickly that actually is going to happen? Because the language Trump used yesterday was immediately.
Right. I mean, there's some speculation that could happen as early as possibly next week, but we really don't have details as of yet. Certainly our colleagues are tracking it and trying to get the information out as soon as we get it.
There's, of course, a great hunger for information here, but also a path. You know, the words that we've been hearing from Vladimir Putin don't always sound like someone who's interested in peace. Bloomberg has reported that he wants to have a total halt in U.S. military deliveries to Ukraine, which the president did not agree to do. At what point do we have a sense of whether this is a real conversation or a Russia that just wants space to regroup?
Well, I mean, that's a major question, certainly that the U.S. negotiators have to tackle. You know, I think they're considering it at least a partial victory to have gotten the Russians to the table in some form or fashion. And, you know, as the Secretary of State has said, we'll have to see once they sit down how serious they are. But as you know, as he put it, the ball was in the Russians' court, and we shall see.
Well, and what Russia at least agreed to at this point is this energy and infrastructure ceasefire, which it seems Ukraine has signed on to. Yet, as Joe pointed out, we also did still see active strikes overnight in Kyiv. Steve Witkoff told our colleagues that was just a delay in communication, essentially getting the message from Putin to the forces necessary. But do we have a sense of what really has gone down in the last 24 hours, and if this already is under formal implementation?
You know, Special Envoy Witkoff's statement mirrored what we heard from the Kremlin in terms of that miscommunication or that delay, and they went on to say that they, in fact, shot down their own munitions. I think it remains to be seen. You know, only now do we have you know, sources saying that Zelensky has agreed to this partial ceasefire with respect to energy infrastructure. So it's really unclear at this point, you know, whether it's underway yet.
Just give our viewers and listeners a sense of what to look for when that readout comes out. What will be important? Because there's a lot of boilerplate that goes into these, of course.
Absolutely. I mean, if there are what we would consider to be, you know, concrete statements of timelines for meetings, next steps, you know, a duration for this partial ceasefire, that, you know, those are going to be really critical. And also comparing what we get from the White House with what we see from Kyiv.
Not always the same.
Yeah, very good point, as was the case with what we got from the Kremlin and what we got from the White House yesterday. Courtney McBride, who covers national security for us here at Bloomberg. Thank you so much. I'm also interested to see, Joe, when we get chime-in from perhaps more hawkish congressional Republicans who have long been supportive of Ukraine. When do those voices on Capitol Hill actually start to weigh in? Because at this point, this is happening at the executive level, by and large.
And of course, lawmakers in their home districts avoiding town hall meetings in many cases. So imagine how different that conversation would have been if Congress was in town here. It's a great point.
Yeah, well, of course, they return next week, and it's going to be an interesting return for the Democratic Party especially, which has had some deep divisions exposed in the effort to keep the government funded beyond the deadline of midnight last week. It, of course, was in part because of a change of heart of the Senate Majority Leader, Chuck Schumer, who decided it was less painful to keep the lights on than to avert a shutdown, or to have a shutdown that puts some resistance on Trump and congressional Republicans. He's obviously got a lot of flack for that, including from House leadership, or those who used to be
that's right.
in House leadership.
Pretty tough words from Nancy Pelosi as the walls start to close in. He had to cancel the book tour. And it's pretty tough stuff. She was at a news conference at a children's hospital in San Francisco. Get a sense of what the former speaker had to say.
I myself don't give away anything for nothing. And I think that's what happened the other day. We could have, in my view, perhaps gotten them to agree to for third way, which was a bipartisan CR for 4 weeks, in which we could have had bipartisan legislation to go forward.
So in summary, Nancy Pelosi felt that there was another way out here, a third way that Chuck Schumer did not take. But the quote, "I don't give away anything for nothing."
That's right.
And this is where we begin with our political panel. Maura Gillespie is with us, Blue Stack Strategies founder and Republican strategist, alongside Democratic strategist Roger Fisk, former special advisor to President Barack Obama. Welcome to you both. Roger, as the Democrat, we have to start with you. Did Chuck Schumer give away something for nothing? And he's certainly getting a whole lot of something in return for that decision.
He's getting a whole lot of incoming fire from his colleagues. But as we all know, the Democrats tend to be that circular firing squad. But thank you so much for having me, and it's great to be here with Maura as well. Whenever I speak with elected officials, I always stress that there's two tracks to look at your potential ascension through. One is leadership, which obviously Senator Schumer has gone on, and the other is kind of national voice, which is where AOC has gone, for example. Because if you're going to go leadership in these situations, you often have to take very institutionalist, very tough votes that are about sometimes just preventing worse things from happening. Whereas if you go the track of trying to establish a national voice, you can then have a little distance from those things and exercise more of a free voice around them. So that's a dynamic I think you're playing out. And I do think that all of these leadership dynamics are always looking for a moment that is going to crystallize kind of some circumstances that have been churning below the surface. People have been unhappy with the last few Senate cycles. So I think there's going to be an appetite for more leadership. And as you're already seeing, for example, with Senator Schatz from Hawaii, people are willing to be very out there in terms of talking about their aspirations when it comes to the next generation of leadership of the Democrats in the Senate.
Enter Glenn Ivey, the Democrat from Maryland, the gentleman from Oxon Hill, deep blue, right outside of Washington, D.C., Maura, at a town hall last night. Quote, "I think he had a great long-standing career, did a lot of great things, but I'm afraid it may be time for the Senate Democrats to get a new leader," unquote. How loud will these calls get from other members on Capitol Hill? Will they make a difference?
They should. The Democratic Party is in need of leadership, right? They've struggled, as was just pointed out, that for cycles now without having a strong voice and a strong leadership presence. And I think Dean Phillips during the last election, presidential election, called this out. He said it's time to pass the torch. And that was refused to do so until June of last year when Joe Biden was forced out of the race by somebody like Nancy Pelosi, who, by the way, will be 85 later this month, who has a net worth of almost $250 million. And she's ruled with an iron fist. She's somebody who has had a long career, but is still pulling the strings in leadership, but not necessarily putting herself out there as much. But she certainly picks her moments. I do think the Democratic Party needs to find its own identity again and decide what their fight is about. If it's simply to be against Trump, that's obviously not working for them. They need to be for something as well. And I just think that this superiority complex that we've seen play out isn't going to be helpful and isn't really resonating with voters. So at this point, I think the calls for new leadership and new direction is going to be louder and louder.
Well, and this obviously stands in contrast to something Joe was alluding to earlier, which is that you currently have Republican members of Congress who are holding town halls back home in their districts and essentially getting shouted out of these places where they are speaking. We saw it most recently with Chuck Edwards of North Carolina, but there have been numerous other examples. Are Democrats doing Republicans a huge favor here, Maura, by having an unorganized opposition to something that clearly is a vulnerability for the people currently in the majority?
They're certainly not helping themselves, but yes, I think there is going to be ripe opportunities for Democrats to point out the failures, perhaps, of what was promised to them at the 2024 election and what's not being delivered. But instead, they can't find that voice, they can't find that path because they don't have leadership. And again, like I said, they've kind of operated from this moral superiority standpoint that isn't resonating and comes across as arrogant. And so at the end of the day, voters feel very left behind. They feel very very dissatisfied with their government. And I think that you're seeing a lot more people who don't feel as though they belong to either party. And we saw it kind of in the last election as well, this political homelessness that we're watching play out. And I don't know that either party is doing a good job of explaining, I'm actually here for you, and here's how I'm going to do that for you. Here's why, and here's how. We're not seeing that. And I think as we get closer to the midterms, that's going to be a bigger problem for both parties, truly.
Well, let's name names here, Roger, because it's easy to talk about kicking somebody out. It's a lot more difficult to replace them with someone who can get the support of the Democratic caucus. Everyone's looking at AOC. This is the whole conversation right now in Washington, which leads me to believe that that may not be very likely. The conventional wisdom is rarely the direction we're going in here. Let's be honest. Chuck Schumer is going to be sitting in that chamber a couple years from now, isn't he?
I don't know that that's as clear a certainty as you might think. We live in an age, and you can look at everything from the Iowa caucus, for example, which at least on the Democratic side, it's all but completely toppled, where anyone who thinks that there's some fixed cultural icon that's impervious to the trade winds, I think doesn't realize how rapid the change can be in this particular day and age. And so I think it wouldn't take much for someone to come out and declare a candidacy now, for example, and then for concurrent with Senator Schumer being primaried, as another example, to bring about a situation where he himself shows himself the door. And that's just the era that we live in. The age of cultural icons being able to withstand attack after attack after attack is over.
Well, so when we consider the battles that are still ahead, knowing Congress will be coming back into session next week, Roger, they're expected, at least on the Republican side, to start dealing immediately with budget reconciliation and that whatever that architecture ultimately is going to look like. What does Chuck Schumer or Democrats as a whole need to do to counter that, knowing that it's expected to be a party line thing? They don't really have a role.
Yeah, I mean, being in the minority in either chamber is very, very difficult. There's the performative nature, as we've seen in committees like the Judiciary or Oversight, where, for example, you could make some headway with Chairman Comer being so concerned about Hunter Biden and his connections with China, and then here you have the same Oversight Committee absolutely refusing to bring Mr. Musk in front of it, who's having a much larger material impact on the trajectory of this country, and by any measure has much more business dealings with China than possibly any other human being alive. So they can make some headway in those performative levels, but and then trying to compile the resistance into some kind of not just an opposition as a reactive, but weave it into some larger fighting for people in a kitchen table sense, very similar to how Senator Slotkin did the response to the address to the nation. That's, I think, the challenge that's ahead of the Democrats for the remainder of the year and on into next year.
That's Roger Fisk. She is Maura Gillespie. Great panel today. Thank you so much both for the insights as we count down to our special Fed coverage. Heather Boucher is on the way in next on Balance of Power here on Bloomberg TV and radio.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Decision day for the Federal Reserve. That decision comes down 2 o'clock Wall Street time. Jay Powell's news conference, 2:30, and we've got you covered on Bloomberg television and radio. Fed officials, by the way, likely to hold interest rates steady. Right now, we've got stocks off session highs, but still a 28-point gain on the S&P 500 index. We're up 0.5%, 56.43. The Dow up 155 now, up by 0.4%. The Nasdaq Composite Index up 129, up by about 0.7%. The Russell 2000 Index of small cap shares pushing higher, up 0.6%. 10-year currently at 4.31%. The 2-year 4.08%. A retreat for gold, little change but lower by 0.1%. 3,032, trading close to a record. West Texas Intermediate crude up 0.5%. WTI 67.27 a barrel, and Bitcoin surging 3.2%. Bitcoin back at 84,660. Again, recapping, stocks higher. S&P right now up 0.5%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Just about 37 minutes to go until that Fed decision, about 7 minutes until our special coverage of it begins here on Bloomberg TV and radio, keeping in mind that it's not the decision itself that is really leaving us in suspense today. It would be a massive surprise if the Fed does anything at all other than leave rates exactly where they are. Where the surprises could come from, Joe, are in the summary of economic projections. What does growth look like? What does inflation look like, at least in the view of the members of the Federal Open Market Committee? And of course, what does the dot plot signal about when rate cuts could resume again?
Yeah, we get 1 or 2. And will they reach for Donald Trump's favorite word in the dictionary is a question I have, not to mention the Doge. Now, what's really interesting is we spent a good long time, I'd say about 4 years, talking to Heather Boucher around this without being able to ask Heather Boucher directly her thoughts on this. But things have changed. The senior research fellow at the Harvard Kennedy School and former member of the White House Council of Economic Advisors with us now in her new capacity as we count down to our special coverage on this Fed Day. Heather, it's great to have you back. Welcome to Bloomberg TV and radio. I wonder your thoughts on this because it won't just be the statement, of course, we're parsing, but the news conference. Will Chair Jay Powell speak to Donald Trump's favorite word, tariffs?
Well, Jay Powell is, a very thoughtful and considered man. He's, been chair for quite some time. And, he understands what his job is, which is the dual mandate. And, he has a very, very tricky job in front of him today, as you've already pointed out. While the actual economic data that's come in, for the most part, has been sometimes a little bit on the soft side, but has been looking, okay. All of the discussion and the forward-looking data about confidence and expectations looks rather chaotic and unsettling. And so I think, we are all watching to see what the Fed does, in terms of how they talk about it. But I think we all know the reality in front of us, which is that the economy right now is being held hostage to this chaos and uncertainty that's coming out of the White House.
So with all of that uncertainty, Heather, with the description you just gave of the economy as it currently is, knowing they're going to provide forecasts of how they expect the economy to look down the road, what is your expectation in terms of revisions we could see to growth estimates and inflation?
Well, already the OECD has downgraded growth for the United States. Certainly these tariffs and particularly the chaotic way that they're being put in place. One day they're on, the next day they're off, and then they're on again. It's very difficult for businesses to plan. We are already seeing indications that this is affecting manufacturers. There's a recent survey in New York State that indicated a sharp decline in business expectations among manufacturers there. So all of that does indicate that the tariffs could be having, the chaos could be having its, I don't know if it's a desired effect, but the effect of making people think twice about what kinds of investments they're doing right now and kind of holding back, waiting for the chips to land and to see where this administration will go. I think on the other hand, from the consumer side, you're seeing consumers getting increasingly anxious. Their expectations are souring, they're expecting more inflation. And again, that makes the Fed's job incredibly difficult, because if they continue to see expectations of higher inflation alongside investment slowing or people sitting on the sidelines as we wait to see what the administration will do, that's not a great situation for the economy.
Heather, you mentioned the dual mandate. I wonder to what extent you expect a change in language to reflect expectations for a rising unemployment rate. Tariffs, one thing, DOGE is another. And at some point, we're going to see the cumulative effect of these federal worker layoffs. What will that say today?
Certainly. And DOGE is an issue for workers being unemployed, having lost their jobs. That is certainly an important piece of the puzzle. But then it's also important for all of the things that those workers used to do that are now not being done, that may be very important for economic growth. Think about what we've seen, of course, with the workers who had been dismissed, who were in charge of the avian flu, which, if that flu continues to move across our economy unchecked, that will continue to have an effect on egg prices, among other things, across the economy. So the impact, though, of DOGE is difficult, I think, for the Fed to get a handle on, to measure, although they have, of course, an incredible team of economists to do all of that work. But the uncertainty, and of course, with all the court cases coming down the pipeline, will those workers be reinstated? What will we see moving forward? Again, this all makes their job that much more difficult, and I think that the chair will remain, as he has already said, the fundamentals of where we are, and of course the economy that the president inherited was quite strong, and we're not seeing the kinds of downturn in the data yet, but I'm sure he will express some caution about what's to come.
Well, and when we consider that caution, it was described by Mohamed El-Arian, who, of course, is a Bloomberg opinion columnist, earlier today with some of our colleagues, as being a question of if he's framing the potential of future cuts down the road as good cuts because progress is being made on inflation versus bad cuts, which is easing policy because things are going south in the economy. How difficult is that line to walk?
Well, what we saw in the first Trump term, when he raised tariffs and that raised prices, the Fed had some room to maneuver because we did not have the legacy of the inflation that we have now coming out of the pandemic. So now they are still working to get the inflation rate back down to their target rate, and at the same time, the tariffs are likely to raise prices for consumers. But they're also seeing people cutting back. Again, with DOGE, you're seeing these effects on employment. So the word that I think people are going to start wondering about again is this word stagflation that we were all, of course, talking about at the end of the first Trump term. That was the word on everybody's lips. That's where we were concerned about the economy being.
What will Jay Powell say about stagflation in our remaining moment, Heather? He's surely to be asked about it in the news conference.
I'm guessing, and I don't know, I don't have a crystal ball, but I'm guessing he won't say the word. I'm guessing that he will continue to, indicate that, because they rely so heavily on the data, that the decision that they are making today is about the data that's already, in check, and they will remain cautious about where things go down the road.
All right. Well, he definitely has a tough road ahead of him just about an hour from now. Heather Boushey, thank you so much. Former White House Council of Economic Advisors, member during the Biden administration, now at the Harvard Kennedy School. We appreciate it as we're counting down here to that decision less than half an hour from now. And the dot plot especially, is the market is very likely to be paying attention to whether or not cuts are going to materialize in a more material way this year than was expected even just a few months ago.
Just to set the baseline here, watching the markets before we get into our special coverage, we're going to kick things to New York in just 1 minute with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. The S&P 500, Kaylee, up 24 points. Not a huge rally, but holding positive today. The 10-year yielding 4.31%.
Yeah, so we'll see how the market actually moves off of this. Keeping in mind, as you quote, where the 10-year yield is right now, that has come down substantially in the last several weeks. And an argument that this administration had made that you don't need the Fed to cut rates to bring rates down and mortgage rates along with it, that other policy could do that job. And maybe we've seen a little bit of that materialize.
That is the message from Scott Bessent, that's for sure. We're bringing the 10-year lower, doing the work for the Fed. With Kaylee Lyons, I'm Joe Matthew. We'll meet you back here 5 p.m. Eastern Time on the late edition of Balance of Power. Special edition of Bloomberg Surveillance. The Fed Decides is on the way next, right here on Bloomberg TV and radio.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live on Bloomberg TV and radio, counting down to another Fed rate decision and Chairman Powell news conference. That decision 27 minutes away. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Farrow. This Federal Reserve says they don't assume, speculate or guess. A little bit later, will they do just that?
With their projections for how they see inflation and growth going forward, a question of how much they will reflect what we hear across Wall Street, which is firms collectively downgrading their expectations for growth and upgrading their expectations for inflation. Do we get a similar tone from the Federal Reserve?
TK, this is a three-part act, a news conference at 2:30 Eastern Time. Before we get there, a non-decision in the minds of many. But those forecasts will be keenly watched.
The forecasts will be really interesting, and I'd sum together inflation and real GDP. I like what Ernie Tedeschi and Martha Gimbel say at the Yale Budget Lab. Quote, things are getting weird. That's what this Fed meeting's about.
Let's talk about that weirdness. Downside risk to growth, upside risk to inflation. Are they worried about one or the other, or both?
And can they really have a Fed put on markets at a time where potentially you have this stagflationary light type of mix? We've been talking about, is the Fed put in action? Is the Trump put in action? Is the Fed put dead? And I ask that in the way that the market has traditionally known it, where they can rescue markets by signaling a more dovish stance. Does that have the same ramifications for a market that is pairing off with both growth risks as well as inflation risks?
Let's check out this market. Equities right now in the S&P 500 just a touch firmer going into this decision at 2 p.m. Eastern Time. We're higher by 0.5%. And this bond market just can't get away from 430. Will that change in the next few hours? Your 10-year, 431.18.
And I do think that the 10-year might be the most interesting one to watch, especially with discussions around quantitative tightening. Well, coming up shortly, Mr. Exceptionalism, or the U.S. not being so exceptional himself, J.P. Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Bank of America's Aditya Bahave. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then immediate reaction from Jim Bianco of Bianco Research, along with Diane Swank of KPMG and Deutsche Bank's Matt Lazzetti. And finally, after we get that press conference from Chair Powell, we'll be hearing from former New York Fed President Bill Dudley, as well as Amanda Lynham of BlackRock, to understand what does dovish mean at a time where there are very different risks that are kind of contradicting each other.
You mentioned Matt Lazzetti of Deutsche Bank cutting his outlook for growth in the last 24 hours and joining a very, very long list of economists who have done just that in the past week. JP Morgan, Morgan Stanley, Goldman Sachs, the list goes on and on.
If the Fed doesn't reflect that downgrade to the growth outlook that we also heard from the OECD, what does that mean in terms of just how much they are really reflecting the growth concerns? Does it actually suggest that they're somewhat more hawkish?
Joining us now to discuss, I'm pleased to say, we can kick off this afternoon's program with Bob Michael of JP Morgan Asset Management. Bob, good afternoon to you, sir. It's good to see you.
Good to be here.
Let's just start with broad-based expectations for this one. What are you looking for?
What an extraordinary Fed meeting. This is one that in 2031 you're going to want to play the tape of and listen to what they talked about. Think about it. They've guided the economy to the perfect mythical soft landing. While they should be tinkering, they find themselves in the middle of an escalating trade war. That's the situation they've got to deal with. I wouldn't want to be in that room with them. I think you're right. We're going to see the outcome in the dot plot. They're going to acknowledge that stagflation is a real possibility. Growth will be dialed down a bit. Inflation will be dialed up a bit. Let's watch where they put unemployment, because that will tell us how they think businesses are going to respond. We think that ticks up a couple tenths.
We were talking about the Fed put and this question about how much the Fed will be inclined to rescue this market from growth concerns. What does that even look like at a time where it's unclear what they could say that could really prop up both growth and dampen rising inflation expectations?
Well, they're going to do their best to be non-committal, but because while they've seen some tariff policy out there, they haven't seen all of it, so they've got to keep their powder dry, so to speak. I think the one thing they're looking at is the level of unemployment. That's going to tell them how businesses are responding to the tariffs that are already in place and how they're thinking about the tariffs that could be coming down the road. I think if they start to see unemployment tick up over 4.5%, they're going to have little choice but to come in and start cutting rates.
We don't do charts for the Fed decides, but I 100% agree with you. If I go back to 1991-92, if I go back to 2002, if we go back to what you enjoyed at JP Morgan in 2007, when the unemployment rate moves, it really moves. Is that where we are right now?
I hope we're not there yet. I hope that businesses are being patient. They're going to wait to see what the actual policy looks like. Right now, it's tariffs on, tariffs off. It's difficult to plan, but if they start to worry and they start to pull back hiring, then I think that becomes a big problem.
Just what is the offset? And you alluded to this. You might get a sign of how the Fed thinks about this in the forecast. How do you think the Fed will be navigating some of these changes to policy that we've seen over the past few weeks?
I think that they're probably as confused as most of us, trying to figure out, are these lasting? I think they're looking at inflation expectations. Is that starting to tick up? That would really begin to worry them. For now, that's not actually happening. So I think they're trying to...
Important distinction. Can I jump in?
Sure.
Market-based inflation expectations, the things that you can tell the world about in just a second, perhaps that's true. Survey-based expectations of the consumer, you, Mitch, etc., they have started to climb, and they've started to climb dramatically. We've seen this Federal Reserve respond to that in the past. Why won't they now?
Well, what you're saying is people aren't stupid. They realize with tariffs coming along that businesses are going to pass some of that on to them. They're going to pay higher prices, and they're going to adjust their consumption because of that. I think the Fed is in a tough spot because while they see that, I think genuinely that inflation could be transitory. It could be there for a year, and then it could pass. They've already used transitory. They can't use that again. I think what they're more concerned about is how businesses respond to a drop in consumption. And if they start to pull back, then they've got to respond and cut rates.
I guess what John's trying to get at, to some degree, is which data are they looking at, the soft data or the hard data? Are they looking at the sort of more rapidly moving sentiment indicators from not just you, Mish, but others, as well as company guidance like Delta? Or are they looking at the figures that are released by the government at very periodic levels?
Well, they tipped their hand a while ago that they're looking at both. When the data, the hard data itself was pretty stable, we looked at their forecasts and they had already started to adjust them. And he admitted that there are some members of the FOMC that were already thinking about how policy would interact with the economy. So I think it's a good Fed. I think they're looking at both. As I said, it's an impossible decision. The tension in the room is going to be very high.
The 10-year yield, if we see some lessening of nominal GDP, does a 10-year yield lead nominal GDP down, or does it follow nominal GDP down?
I think it will lead. I think that there will be a flight to quality in the Treasury market.
Where's your level on that? Where's your signal point, your trigger point, where the level of the 10-year yield where that touches?
I think we could go through 4% to 3.90 in a material slowdown. where the market starts to begin worried about unemployment rising.
That's great, John. You can get into that 8,000 square feet you're looking at.
You think rates are going to come down that much, TK? I need rates at rock bottom. I need like 1% interest rates again. That's not going to get it done.
Yeah, mortgage rates just rose again for the first time in about a month, but whatever. Bob, I do want to ask, though, about that 10-year yield, how dependent it's going to be on any kind of discussion of quantitative tightening and potentially pausing it or starting to slow the amount of treasuries that it's letting roll off its balance sheet.
So let me just say, I hope the Fed doesn't change rates this year. I hope the 10-year stays where it is. I like yields where they are. That can bring in a lot of investors to the bond market. I'm a bond guy. Come on in. But you've got the Treasury Secretary out there saying that they're targeting the 10-year. And certainly pausing quantitative tightening is one way to do that. And then I think what you're also going to see is reinvestment of mortgage roll-off into the Treasury market. So those kinds of tools will keep the 10-year at least stable where it is and likely push it down a little bit. And although I expect them to say pause, we don't believe that they're actually going to pause. We think they're done.
Lisa, you're right to bring up QT. We spoke to a range of guests this morning on the program about that. Very, very split about what we might see in the next hour.
Yeah, Gennady Goldberg coming out and saying he doesn't think that they're going to pause quantitative tightening until at least September. Where meanwhile, Aditya Bahave is coming up with Bank of America, thinks that they're going to announce it in some capacity. Deutsche Bank's Matt Lazzetti, I think, is sympathetic with that view. So a real sense that that might be the big news from this press conference.
That decision is 18 minutes away. Bob Michael at JP Morgan Asset Management will be sticking with us. Just a flavour of the bond market for you this afternoon. Bond yields are higher by 3 basis points at the moment on a 10-year, around 4.32. At the front end of the curve, up 4 or 5 basis points, reapproaching 4.1%. Coming up in just a moment, we'll catch up with Bank of America's Aditya Bahave in just a second, alongside Kathy Jones of Charles Schwab. Live from New York City this afternoon. Good afternoon.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
In case you missed it, on Bloomberg Surveillance, Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now, all the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Don't miss Bloomberg Surveillance, live every weekday.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The Fed, like so many others, are navigating a regime change.
They've been pretty clear that they're on hold here. We're going to stay on hold for a little while.
The Fed isn't in a position to cut just yet.
They'll probably wait and see. I don't think that they want to surprise the market hawkishly here.
They can no longer maintain that we don't speculate, we don't guess on policies.
The hard data and tariff information are really, we think, going to overshadow anything we'll get from the Fed.
They have got to take a view.
People are looking for the Fed to sort of come to the rescue.
That Fed put is something we won't see.
The Trump and FOMC puts, if they exist, I think are much further out. We've gone from huge confidence in a Trump put and a Fed put to questioning both.
That's been the big change over the last several months or so since the Federal Reserve last met. Your decision is 15 minutes away, and going into it, your equity market looks like this on the S&P 500. Equities here just a little bit firmer, but you know the story over the last 2 months. Since the Fed last met, this stock market is lower by about 6%. In the bond market, 2-year, 10-year, 30-year, your scores look like this at the moment. Over the previous few weeks, just glued to 430. Really tight trading range. On a 10-year at the moment, 431.57. Where you have seen a major change, though, so far this year is in the FX market. To see euro dollar getting closer and closer to 110 in a year, when only a few months ago we were talking about parity, Lisa, all over again.
And it comes at a time where people suddenly are looking at a seismic shift in German politics, where suddenly they are embracing fiscal spending, and that has completely changed the game at the same time that people keep going to gold as a potential diversifier, up 10%.
Read my script notes over here. That's right where I wanted to go. On the show, folks, I got to quote London Bullion Market Association. Gold or Farrell won't talk to me, but the answer is London Gold. Here's a moonshot, up 19% from the November bottom.
Who would have thought we'd be putting gold on planes coming to New York from London? And that would be an economic story. Who saw that coming?
No, you're doing that from Bulgaria, right?
All I can say is I feel bad for people's backs who have to actually hoist those suitcases up. Do you know how that would be terrible?
Like Van Cleef for Bulgaria. Which do you think?
All right.
TK's got experience. He's the only one around this table with experience of carrying gold bars into London Heathrow.
I can see that.
Joining us now is Kathy Jones of Charles Schwab, Bud Michael of JP Morgan Asset Management still with us. Kathy, welcome to the program. Decision just around the corner. What are you and the team focused on going into this one?
Well, I think we'll be looking very closely at the dot plot. I don't expect the median estimates to change, but there is some risk that given the rise in inflation expectations we've seen in some of the data, that those numbers shift up. And that would be a big shock if we went from expecting 2 rate cuts this year to just 1. So that's something I'm keeping an eye on. I don't think it's a high probability, but, you know, inflation expectations are something the Fed's really focused on. And when you look at the surveys, not just the consumer surveys, but the things coming out of the various regional Fed banks, you're seeing a lot of concern about tariffs, price pressures, growth pressures at the same time. And I think the Fed takes those surveys very seriously. So I'm a little concerned that we get this kind of stagflationary signal from the Fed that the market's not really prepared for.
Kathy, the Fed has a couple prongs that they could pull today. One of them is indicating how many rate cuts they're expecting on average, potentially, with assuming and suggesting among Fed members later this year. And then there's quantitative tightening. There's a balance sheet that has come down substantially from the all-time high, allowing them to roll off the maturing debt and not reinvest it. If they stop allowing that debt to roll off their balance sheet, would that be more supportive to markets than anything they could do with the front end of the yield curve?
You know, I don't think so. I mean, when we look at quantitative tightening, we don't really see a good correlation with movement in the market. And I think it's a bit more technical than that when they consider ending QT. So it does free up some liquidity at the banks. I'm sure a lot of people will take some you know, excitement from that or view that as a bullish sign. But I really don't think that outside of freeing up a little bit of liquidity with the debt ceiling hanging over us, that's really going to be a big signal for the market.
Kathy Jones, 10-year real yield, 2.00%. Nice, convenient number. What does that signal to you, and where will it be 6 months, 12 months out?
Well, I think it signals it is a pretty good. You know, 2% real yield. That's pretty much near a long-term historical average. It might be a little bit lower than it was in previous decades, but for this market, 2% real yield's pretty attractive. And I don't know that it's going to change a whole lot going forward. I would think it might come in a little bit if we get sort of expectations on inflation down. But by and large, I think 2% to 2.5% is a pretty good spot for real yields to be at the longer end of the curve.
If the Fed, Kathy, puts out projections that do have stagflationary type tendencies or trends baked within them, what does a Fed put look like going forward?
You know, I think, you know, if if we believe in a Fed put, I'm not sure I believe in a Fed put, but if we believe in a Fed put, it really has to be more about if we run into an economic problem that the Fed has to act to counter. And so I don't know that there's a signal that we would see in this kind of a meeting, because we're not into an economic downturn of such magnitude that they have to do something. Yeah, the stock market's down from the highs, but it's clearly still pretty high. And the economy, although it is slowing and we see some softness underneath the surface, it's not collapsing. There's no crisis at the moment that the Fed needs to address with a Fed put. So I think they would really like to reserve that for some sort of crisis situation or a very serious situation that weakness, say, in the financial markets would somehow transfer into the real economy. But at this moment in time, it doesn't seem that bailing out a market at this level makes much sense for the Fed.
Let's build on this conversation and bring in Aditya Bhave of Bank of America. Aditya, welcome to the program. Was reading your research over the past week or so on this Fed decision. You said the Powell put is not forthcoming. You're anticipating a stagflationary mix in some of the forecasts they unveiled in about 9 minutes' time. Let's talk about those forecasts together, Aditya. So in the SEP last time around, the 2025 GDP forecast was 2.1%, unemployment rate at about 4.3, PCE, core PCE 2.5, and a median dot plot basically signaling maybe 2 cuts for 2025. What do you think about all of that ultimately changes in the next 10 minutes or so?
Good afternoon. Thanks for having me. So we expect growth to be marked down a little bit to 1.8%. I think they can do that without getting particularly political, because they can just say, look, this is just a reflection of the expected weakness in first quarter GDP, right? And then on the inflation side, equally, just as a reflection of the last 2 months of data, which really have been quite disappointing without any tariff impact, we think they can go up to about 2.7% on the core PCE. We don't expect the dots to change, so they stay frozen at 2 cuts for this year. But if you really want to see what they're thinking, why they don't want to tell you what they're thinking, look at the distribution of risks. We think the distribution of risks at the back of the SEP will show a meaningful shift towards weaker activity and higher inflation.
Which raises a question of how they can respond to this. This is the nightmare of central bankers around the world. Stagflationary-like kinds of trends. How do they message that they want to support an ongoing recovery while countering some of these trends, while remaining non-political?
Right, so here's our framework for this. We understand that stagflation pulls their 2 mandates in opposite directions. So then you have to ask, where do you have buffer? We think you have buffer on the activity side of the economy with the labor market close to full employment, with growth well above trend, and financial markets at least starting this period of weakness from all-time highs in equities, right? Whereas on the inflation side, you don't have any buffer because you're already above trend. That's why we think that it's going to be very difficult for them to cut unless there are quite significant risks of a recession, which we don't see. And that's why we don't have them cutting any further.
Bob, Michael, I'm going back and forth here between the dots and my bracket, and I'm really having trouble here. I mean, both of them are a complete fiction. How do you construct dots right now? I don't know how you do it in a normal time. How do you construct a Fed estimate of dots here, or is it like picking the bracket?
Well, I think they've told us they believe that the neutral Fed funds rate is much lower than where they currently are, so their bias is to look for an opportunity to bring rates down. I think Aditya is right. I disagree with them all year. They may not cut rates, but I think over the next couple quarters, they're not going to have an opportunity to cut rates, but they're going to bring them down. We're going to see that in the dots.
Is the dispersion going to widen today? To me, that would be the shock. I just don't see that. But is it the spread of the dots today?
Yeah, I think it has to. I think there will be those who are hawkish that will be concerned about inflation, and there will be those who are dovish that will be concerned about rising unemployment, and that's the opposite pole that Aditya talked about.
Just gauging how market participants, TK, feel about this over the last couple of weeks or so. The hawkish risk here, and I'm sure, Bob, you might agree, the hawkish risk here going into this meeting is that you downgrade your growth outlook. You have to push the unemployment rate up for the next year or so, and the median dot stays the same and still signals 2 cuts. That would be a hawkish development, and that's the risk for this Federal Reserve. They do nothing. They try to do nothing. The rest of the world changes around them, and doing nothing, the meaning of that changes. Is that the hawkish risk going into this one?
I'm not so sure that's entirely hawkish. I think the market is more or less expecting that. I think if they bring down rate cuts to 1 dot, to 1 cut, that would be particularly hawkish. That would worry me. And then I would be concerned that they're actually not expecting inflation to be temporary. They're not looking through it. They're concerned that it will be entrenched at these levels.
On the flip side, Aditya, I'd love your thought on this. If they are somewhat dovish and they do feel like, or they give the sentiment that they are more concerned about weakening growth than inflation, does that lead to a massive sell-off in the long end of the yield curve?
I think that's going to be very positive for risk. So let's start with that. And, you know, on the long end, it's mixed because it also depends on what happens with QT and so on. But that I think would be a very, very encouraging thing for risk assets, although nothing that they've told us to date suggests that they're going to go in that direction, right? I mean, all they've told us is we don't know what's going to happen, and essentially, therefore, we are frozen where we are.
Well, Bob, you're nodding, but I wonder, at a certain point, we talked about how after they cut by 50 basis points, we saw a huge rise in 10-year yields, and people said, oh, they made a policy error. Well, why wouldn't this sort of fear of doing that again prevent them from taking a more dovish tilt, at least to the near term?
Because I think back then the market was very excited that they would be on a path to 3%. And then you started to see how the election was going to evolve. You saw the policies coming out of that, and people quickly reversed, we're going to 3% to, you know what, we'll probably stay in the 4 somewhere. And that got priced into the market, and the Treasury market adjusted to that. I think it was that simple. I think actually the Treasury market's in pretty good tune with the Fed. The Fed's in pretty good tune with the data. The question is, what will the data be 3 to 6 months from now? The sentiment, or will it all have changed yet again?
My head hurts with the dots discussion. Kathy Jones, save me here. With the unusualness of the moment, what do you do with a portfolio duration or maturity? How do you nudge that? Which way do you move?
We're pretty much hugging the benchmark. So for us, the benchmark is the ag. It's around 6 years. You get a 460, 465 yield on that, all investment grade, high quality. I think it's a pretty good baseline. If you're a risk taker, maybe use a pop in yields to extend duration a bit, because we do see the economy slowing down in the second half. But, we're not ready to do that. And we're saying up in credit quality because we are seeing a deterioration under the surface in some of the weaker credit. So we're just kind of hugging the benchmark and waiting to see what happens.
Hey, Kathy, appreciate your time this afternoon. As always, Kathy Jones of Charles Schwab, alongside Aditya Bharve of Bank of America. That decision 2 minutes away. Bob Michael, just a final word going into that decision.
What I heard from Kathy is they're buying bonds because, like us, they're seeing net inflows to the bond market. So you can be neutral, you're still buying bonds. I like the bond market here. We're buyers on backup in yields and credit spreads.
I imagine you're not alone saying that. Is there this wall of money that people talk about? Sounds a little cliche, but is there a wall of money waiting for any backup in bond yields?
Yes. All kinds of pools of investors are under-allocated to public fixed income.
Seen a massive sentiment shift to Europe and other parts of the bond market, haven't we, in the past year or so? This one's a big one. This really is a big decision. This is a tough decision, not because they're going to move 25, 50 basis points. It's not about that this time around. It's about how you navigate these policy changes, this effort to push a global realignment driven out of Washington, D.C. You've got to try and gauge the response of other actors, China, Europe. You've got to understand what it means for markets, consumer expectations, how that's going to translate into things like inflation, growth over the next several months, and somehow put out projections for the world to interrogate.
Which people will have to understand is something of a dartboard, throwing darts at it. Some of the questions, and I wrote down a whole host of them that I have for Fed Chair Jay Powell today. One of them is, are you more worried about stagflation-like conditions today than you were on January 29th? And if so, why? What has changed? And see how that gets navigated.
I look at their dual mandate quickly here, John. The dual mandate, it's all about labor, and it's moving the second derivative of some of those series. Bernanke would say there's a lot of hockey sticks out there.
And is there a stagflationary mix in these forecasts? Remember, this is a three-part act. In about 10 seconds' time, you get two parts. You get a decision and the forecast. 30 minutes later, you will have a news conference with Chairman Powell. The equity market going into this one firmer by 0.4% on the S&P 500. With the decision, here's Mike McKee.
Well, I was wrong. We do have some news today. No change in rates, but a significant cut in the Fed's view of growth over the next 2 years. A majority of the committee moving lower on the dot plot, even though there's still 2 cuts forecast for next year. There's a pause in QT and a dissent on that. The benchmark rate stays the same, 4.25% to 4.5%, but the policymakers cut their median GDP forecast for this year to 1.7% from 2.1%, and next year to 1.8% from 2%. Headline PCE inflation rises to 2.7% this year from 2.5%, and core to 2.8% from 2.5%. The unemployment median for this year is now 4.4%, up a tenth. In their statement, officials removed language that risks to the employment and inflation mandates are roughly in balance, now saying the committee is attentive to the risks on both sides of its dual mandate. They emphasize that by saying uncertainty around the economic outlook has increased. That's reflected in the dot plot. 8 members now see 1 cut or 2 cuts or fewer. The median stays at 2 cuts with 2 more for 2026. The Fed, beginning in April, will slow its balance sheet runoff to $5 billion a month from $25 billion for treasuries. It will retain the $35 billion cap on mortgage redemptions. They don't attribute the change to anything, not to the debt ceiling, but we would expect Chair Powell to talk about that in his news conference. But the change in the runoff drew a dissent from Governor Chris Waller, who approved of the no change in policy rates, but dissented on the idea of slowing the balance sheet runoff.
Mike McKee, there's so much to work through here. Appreciate your time, sir. Apparently, stagflation is bullish. We'll get to that in a moment. We are firmer in the stock market by 0.6% on the S&P. On the NASDAQ, we're up by 0.8%. Mike went through the forecasts and the revisions. Let's do that again, because these are significant changes. Let's focus on 2025 and look at the median projection. The change in real GDP. The projection now, 1.7%, down from 2.1% previously. Those forecasts made back in December. Unemployment up to 4.4%. The previous forecast was 4.3%. Core PCE, 2.8%. The previous projection, 2.5%. And the median dot, unchanged. So, Lisa, what we've got here is the Federal Reserve essentially saying inflation is going to be higher than we thought it would be. Growth is going to be weaker than we thought it would be. And as for policy, well, policy doesn't change. That is the stagflationary mix in the forecast that some people were anticipating.
Because we've heard it from all across Wall Street. If they hadn't done this, that would be sort of surprising, since they seem to be reflecting a general sentiment out there. Key question, how are they going to explain why? What has changed? Given the fact that, yes, we've gotten data that has come down, but we haven't necessarily seen a big spike up in inflation, and depending on what inflation expectations you've seen, you haven't necessarily seen them go up that much either. I do think it's interesting about quantitative tightening. I do think it's interesting about Fed Waller dissenting, and I'd like to hear a whole lot more. I also think it's interesting you're not seeing a huge reaction from the 10-year yield on that.
He's running. Talked about that a few times. We'll come back to that later. If you don't know what we're talking about, Jim Bianco has thoughts. I'm sure he joins us in just a second. Let's turn to the bond market. Bond yields were higher going into this decision. They are now just about unchanged, around 430. So we haven't broken out that range, that very tight trading range over the past few weeks on a 10-year maturity. The 2-year at 4.03%. There's a lot of conflicting stories, a lot of cross currents to this decision here, Lisa. You've got stagflationary mix in the forecast. The median dot remains the same, implies 2 cuts for 2025. And then you're slowing down the balance sheet runoff at the same time. This is going to be a really tough news conference to navigate for Chairman Powell. With those forecasts, it gets harder.
Especially because he's not giving any explanation as to why they are pausing quantitative tightening. He has to explain why they are changing their forecast and why they haven't changed how many times they expect to cut rates. How do they balance these two risks at a time where, again, stagflationary-like scenarios are the worst-case scenario for a central bank?
Buried in the headlines is a single one. FOMC median this year unemployment projection rises to 4.4%. The moment that overshoots, the dialogue changes. I don't know, with all of our esteemed guests, John, I'll let you decide. Is 4.5 a trigger point? Is 4.7? To me, it's a round number, 5%. But I'm sorry, 4.4% is emotionally, for President Trump, a long way from where we are right now.
Tom, I think we have to be really patient about how we process and internalize what the Federal Reserve is telling us this afternoon. I often say when we get a Fed decision or economic data, these are the market moves, let's see if they stick. These are the market moves, we'll see if they stick. I don't think the market moves right now should shape the narrative too much. Just take a step back. Don't even look at the market. The Federal Reserve is telling you that they've had to dial back growth expectations, but that won't lead to lower interest rates. The Federal Reserve is telling you that on the margin, unemployment's going to be a little bit higher, but relative to what we thought back in December, that doesn't mean additional interest rate cuts. On the surface, looking at that alone, and I know there's a lot more going on here, that's a hawkish decision from the Federal Reserve.
On the margins, this is them saying that they need to prioritize inflation just as much as unemployment rising to 4.4%. And that right now, the market's grappling with at a time where inflation is as much of a risk to asset prices as is potentially downward growth.
And look at John, a message just in from Drew Mattis of MetLife. He's getting closer to being a net buyer of treasuries again. I told him to call Bob Michael.
Bob Michael's with us now from JP Morgan Asset Management. Bob, we gave you some time to go over this one. What are your thoughts?
This is a dovish Fed. When I look at how they changed their expectations, they lowered GDP by more than they raised inflation. That's tip number one. You look at unemployment, they're worried about how businesses will respond. So they raised unemployment. That's tip number two. And then they said, I believe, uncertainty around economic activity increases. Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
Put your interest rates where your mouth is, not you, Chairman Powell. Why have they kept the median dot unchanged? What's that about? If they are that dovish, if you're downgrading growth, shouldn't you back that up with a lower median dot?
Well, I think that they're comfortable with the 2 dots where they are. It's 2 more rate cuts. I'll take it.
Jim Bianco of Bianco Research can get in on the conversation. Jim, I'd love your thoughts on this situation. We talked about it, lots of cross currents, lots to process. Where do you stand on what we've just heard?
Yeah, I agree with a lot of what Bob was saying about that nominal GDP came down. In other words, they cut the real growth more than they raised the inflation rate. But I think ultimately, I've termed this the meeting before the meeting. I think the most important meeting for the Fed is going to be the May 7th meeting. All right, they cut their forecast. We've got the histrionics of a 10% correction. We're all talking about tariffs. If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year unless something else comes that we don't expect. And I think when you look at the market right now, at least the initial reaction in Fed Fund futures and the like is that they're not going to cut rates at that May 7th meeting. So we'll have to see what transpires in the press conference that kind of gets us going there. Because like I want to emphasize it again, what more would they need to see at May 7th that they already haven't if they go to that meeting and they don't cut it? So this is the meeting before the meeting.
There's also a question about just how much inflation expectations are going to tick up and what the signal is from them pausing the quantitative tightening program. Jim, it's in the weeds. We've heard from Kathy Jones. That's just a technical adjustment. It's not going to make that big of a difference. Does it represent something more to you?
Yeah, only in the extent that a lot of the quantitative tightening, the rolling off of the balance sheet was that they weren't buying mortgages to the extent that they used to. And that has become a bit of a political football for the Fed. In the era of high mortgage rates, they seem to be backing off and trying to support lower mortgage rates. Well, now they're trying to do that by, so I think that there is going to be, some issues with that, and there's going to be some discussion about why they did it. And I hope he's asked, and I'd like to hear a good explanation for why, because obviously it wasn't a unanimous decision. Fed Governor Waller dissented from it.
Jim Bianco, to give you a victory lap on the last time the White Sox won 3 games in a row, you nailed transitory inflation. You nailed the stickiness of it. If we get inflation to come in with this low growth estimate, how will the Fed respond to that?
I'm afraid, that it's going to be more like what we saw in September. That when the Fed, I'm in the camp that when the Fed cut rates by 50 basis points in September, The bond market looked at it and said, look, you're not serious about inflation, so we're not serious about the bond market, and yields went up. I know we try to blame Trump and the Trump policies and that, but it turned right on that Fed meeting when Harris was leading in the polls and interest rates started to go up. So it was more about the Fed meeting and them being aggressive. So if they're going to respond to the idea that the economy is slowing, but inflation is staying sticky by cutting rates or threatening to cut rates, they run the risk of the same reaction again. You want to produce 5% in the 10-year rate? Well, then, cut rates when the market is still worried about inflation. And I'll remind everybody, we've had 46 straight months now of core inflation above 3%. And the Fed keeps talking about their target being below 2. We can't get core inflation below 3, let alone get to their target of 2%. And if they start cutting rates again, they run a very big risk of a bad reaction.
Jim, how does an explosion of fiscal spending in places like Germany and China complicate the story when suddenly there's a lot more competition around the world for the dollars or the currency to fund people's deficits?
Well, I think the first thing you'd have to look at is, the example that we had with the CARES Act in 2020 with an explosion of fiscal spending was inflation. And I think you're probably going to see an uptick of inflation in Europe, and that's going to reverberate through everywhere. Remember, when we had our uptick of inflation, so did they. I suspect if they have an uptick of inflation, it will come back to us, not $1 for dollar, but we'll see an upward push of an inflation. And I also think that that's also going to attract capital to Europe. They've got, they got down to like a 10 PE on a lot of their stock markets where we were above 20. So they're a cheap market, and now they're stimulating, and they're willing, and at least equity investors will be willing to tolerate more inflation, but bond investors won't. So I think you'll start to see higher, you'll see those higher rates in Europe continue, and maybe higher inflation rates, and that will come back and be more problematic for the Fed if they want to cut rates later on this year.
Hey, Jim, appreciate your time. As always, buddy, Jim Bianco there of Bianco Research. Miami Keys run to the news conference. You'll see him ask a few questions, I hope, in about 20 minutes' time. He writes in, look closely at the dot plot. 8 members now see 1 cut or fewer. That's up from 4. Only 2 now see 3 or more. That's down from 5. It won't take much to move the median in the other direction. This is where I'm struggling with this decision. I feel lonely around this table. I see stagflation readjustments in the forecasts. I see a Federal Reserve that's not accompanied a downgrade to growth, with an upgrade to the amount of cuts we'll get this year. In fact, quite the opposite. And they're telling you things are really uncertain right now. So it's not obvious to them how they would respond to adverse shocks in the economy. That's a change for this Federal Reserve. Typically, it goes something like this. Growth's bad, we can respond. We're not constrained because inflation's going to be lower. That's not what they're forecasting right now. Now, this can all change in the news conference. Maybe Chairman Powell could explain this in 15 minutes' time. But I just sit here and I just say, look, if I didn't see the market, I'd be sitting here thinking that was a very hawkish mix from the Federal Reserve. I know I'm very lonely. Jim disagrees, Bob disagrees, but that's what I see right now.
You're not so lonely. There is a shift in the mentality around the Fed right now, which is that disinflationary process is squarely on its trajectory downward, is no longer valid. That has been a shift, and they can no longer count on that to allow them to just unabashedly respond to downside growth shocks. And that is what you're seeing reflected in those dots. And on the margins, that's hawkish, because they're not going to necessarily come to the rescue in that way. That said, do people believe these dots, et cetera? That's another story. So that's, I think, where maybe people are leading some of their confidence.
Bob, is stagflation bullish risk assets?
No, it's not. It's a pernicious ingredient into risk assets. So,
what can you take away from the fact that this is a stagflationary mix to the adjustments of the forecast from the Federal Reserve, and they seem to be very uncertain about what to do with policy? Well, when was the last time they were in this position?
It's an expected stagflationary environment,
Fair
and
point.
We're not in it now. And I think when you talk to a lot of corporate managements, you'll find that they're pretty guarded and sanguine about what they're doing. So I do worry that if what we expect to happen actually happens, then the response from
Dan
corporate
Swank
America will
of KPMG is going to jump in on the conversation. Bob's going to stick with us. The news conference starts in about 16 minutes' time. Dan, you've had 14 minutes to pore over all of this. What jumps out for you?
I actually am on your side of the equation here. I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment. We've seen several Fed presidents come out and evoke the 1970s as a cautionary tale. This is a stagflationary forecast, not a horrible one, a very mild bout, but the uncertainty factor is really true. I think what you're going to see Chair Powell do is separate the balance sheet issue, because excess reserves are starting to get to that point that they really need to slow down quantitative tightening so they don't have a hiccup and some kind of seizure in the Treasury bond market. They don't want a repeat of that September 2019 event, and that's what they're hedging against. They still want to run off their mortgage portfolio. They don't want to hold mortgage bonds. Their mortgage bonds, they're going to roll off when people buy those homes because nobody wants those right now. They're not just going to easily roll off in a very stagnant and stuck housing market. But I see this as a much more hawkish kind of tone from the Fed. Also important to note, the ingredients that go into the PCE, which the Fed has already calculated between 0.3 and 0.4%, an acceleration, not the cooler numbers we got in the CPI and the PPI. It's going to be 2.8% core PCE next Friday for the month of February. That's an uptick in inflation, both on a month-to-month basis and year-over-year basis. They know that. They've made that calculation as well.
Diane, across Wall Street, a lot of people have downgraded growth expectations and upgraded inflation expectations, talking about the policy mix in Washington, D.C. How does the Fed address this without getting political?
Well, that's why you're seeing so much uncertainty, and they just say, we're not going to front run any policies. This, unfortunately, leaves them in this data-dependent mode, and we don't know what the decision rules are on what kind of unemployment and what kind of inflation number are going to make them pull the trigger in one direction or the other or stand hold. They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy. That's going to be a very pregnant pause. I don't think there's any chance that they cut in May. I think that's a very low probability. We do not have a cut this year until early 2026 because of the underlying upward pressure on tariffs. Now, much we'll find out, more information on that on April 2nd. And then, of course, it matters in terms of how it actually plays out. The Fed does not want to front run this. I think that's the most important message that Jay Powell is going to try to point out, that he's only going to react to whatever happens in the economy. That keeps him out of the political fray.
And Diane, we talked to a lot of people in fancy zip codes who tell us things are slowing down, whether it's Morgan Stanley or UBS today. What do you see where you are, from Aurora over to Gary, up to Waukegan? I mean, within the Goolsby district, what are you actually seeing in labor dynamics?
We are seeing some slowdown. I spend a lot of time talking to a lot of small businesses in the area as well. And one of the things we're really starting to see is things like that pullback in restaurant spending that we saw in retail sales, this sort of hesitancy, builders complaining that people aren't walking through, doing the, seeing the kind of looking for houses that they had seen out there before, not seeing the foot traffic they once did. Those are things that are important because that's sort of reflective of some of the consumer confidence numbers. Now, we've also seen a lot of front running of tariffs, and every company I know out there is trying to hedge their tariff situation. That's already pushed up costs of many things even before the tariffs that we have currently went into effect, and they're now having to deal with that as well. And that's a very challenging environment. There is a real chill, of course, in terms of what is the carve out for USMCA, and many companies that technically qualify for USMCA and the carve-out that they hope to get in the auto industry on April 2nd, they did not apply for the permission on that because there just wasn't a reason to before, and now they have to be certified. So this scramble in terms of, I'll tell you, our tax and customs group, and I'm working with them constantly, and logistics are absolutely slammed right now.
Diane, there was a time when Tom and me got in trouble for calling an ECB news conference a snooze fest. We're not going to get in trouble this time around because this won't be a snooze fest. This is gripping stuff, Diane. I just wonder from your perspective what you would ask Chairman Powell as that news conference begins in 10, 11 minutes' time.
I think the most important thing to ask, because he's not going to be able to tell you what the actual reaction function is, but we know they're doing scenarios. He talks about scenarios. We need to sort of push him on what are the scenarios that the Fed's looking at right now, and what does that mean for policy?
John, Ian Lincoln, publishing at Bank of Montreal, BMO, he supports John Farrow's view. The distribution of projections shifted hawkishly.
Look, the fact we're having a debate about it means that Chairman Powell needs to address something in about 10 minutes' time. Dan Swong says it's hawkish of KPMG. Dan, appreciate your time as always. Bob Michael of JP Morgan Asset Management says it's dovish. Now, maybe we can explain this by saying that there are different seats here. One is an economist, just talking about things as they see them. Another is a market participant saying, well, this is what was priced and this is what was expected in financial markets. And maybe you can make that argument this afternoon. But I do think, if you take the market out of it, Lisa, if I just looked at those forecasts, if you told me they'd be downgrading growth expectations and maintaining interest rates, in fact implying that maybe it'll be 2 cuts or less, not 2 cuts or more, based on where the median dot and the distribution of dots was last time around, I think we'd all agree that that was a touch hawkish.
I think the vocabulary has changed. And frankly, this scenario is gotten away from the vocabulary that we used to use in a very different time. If you're talking about stagflationary-like environments, suddenly the definition of hawkish and dovish takes on a very different approach.
The rules have changed. Matt Lazzetti joins us now of Deutsche Bank. Matt, welcome to the program. We've got a split decision here. You're going to be the break-in vote. Matt, where do you go? Is this dovish or hawkish this afternoon? What is this?
I would love to be the two-handed economist at this point, just telling you it's either hawkish or dovish. I think, given the downgrade to growth, and the increase in the unemployment rate, the fact that you saw an upward shift in the dots is kind of clearly a hawkish signal. At the same time, the fact that the Fed is telling you that they are cutting rates a median expectation 2 times this year, with core PC inflation that's 80 basis points above their target and growth that's essentially around potential, kind of continues to signal that there's a dovish bias there. So I think there's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of 1 rate cut for today, and so far at least that fear was alleviated.
Matt, you expected them to pause their quantitative tightening, this idea of allowing their balance sheet to shrink. Does this actually mean anything other than just a technical adjustment to smooth the gears of Wall Street?
No, I think for the Fed, this is clearly a technical decision. They slowed rather than paused. But again, I think that was kind of a technical decision about how they were going to deal with MBS and the fact that they might have to buy in the secondary market. And so really, this is just the Fed telling the market they're going to be very cautious in dealing with the balance sheet. They don't want to repeat the mistakes of September 2019. And they're going to be just cautious in dealing with how things evolve here.
I'm going to go to strategist John Farrow on this. You can't make this up. Out on Twitter, Ed, thank you so much for this for John Farrow. My 16-year-old son has saved $500 and wants to invest it. Should he wait till after the press conference?
This is what do you think? That is the $1 trillion question. Matt Lazzetti, how do you think the chairman will approach this news conference in 8 minutes' time?
Look, I think he should just be repeating how he's been discussing the outlook, which is there's a lot of uncertainty at this point in time. They still think the economy and labor market are solid. They're in a wait-and-see approach here, and they're in no hurry to adjust rates. And I think by the May meeting, by the June meeting, they're going to have greater clarity on how some of these policies are working out. They're also going to have greater clarity on the fallout from the big spike in uncertainty that we've had over the past month. So by May or June, I think we should be hopefully in a reduced uncertainty environment with greater clarity about what the policy outlook is.
Matt Lazzetti of Deutsche Bank. Matt, one of the best. Appreciate it, sir. That news conference is about 7 or 8 minutes away. Whatever you think about the decision, you've got to reflect how the market has responded to it. There's always a signal, some information there. And right now, the equity market is firmer off the back of the decision, Lisa. We are firmer by 0.8% on the S&P.
Because they maybe caused quantitative tightening, maybe because they still signaled 2 rate cuts. All I know is on the margins, the bond market is sort of slowly getting around to the same kind of dovish response to this meeting. Again, hard to say what that means, especially given the fact that this news conference is going to be the most important part of this whole 3-part act.
Bob Michael, you've seen a million of these in the past. What's unique about this news conference with Chairman Powell that's just about to start?
I've been watching a couple things. For the last month, we've watched gold go up and flows into short-duration government bond funds, which told us investors were looking for the safest anchor in the storm. While we're seeing equities drift higher today, maybe it's a little bit of relief, we're seeing the same response. Investors are trying to counterbalance that. Gold has turned up. It's about up $5 an ounce. It was down, and money's gone into the Treasury market. This defines the conundrum in markets. It feels good right now, but there's an expectation things are going to get a hell of a lot worse when broader tariffs hit. Yeah. How is the Fed going to deal with
John, importantly, not only is gold up, gold is up to record highs.
All-time highs, through 3K.
Which has raised this question about what's going on. Is there this larger question about assets moving away from the United States? I just wonder, you say it feels good now. Does this feel good? Does this sort of projection feel good for anybody? I mean, what do you do with this? How come risk assets seems to still be looking for a Fed put at a time where the Fed is telling us we have no clue what to do?
I think everyone's relieved that the Fed didn't jump to significant conclusions, that you're not seeing 0 or 1 rate cut. And I know there's a change in the balance, that they didn't raise inflation expectations to over 3%. I think we'll look further into the statement. I think investors took comfort from that this is going to be a balanced and stable Fed. They know about as much as we do, and who knows what's going to happen over the next couple months.
Is Fed policy still in a good place?
It's in a great place. It really is. I think it's a miracle. They got us to 4% unemployment, 4% wage growth, 2-ish% GDP, 2.5% inflation from where they were, and now they've been dealt a real problem with a global trade war, which is a stagflationary economy killer.
So I'm going to ask the question slightly differently then, but it's the same one. Is the Federal Reserve in a good place? For any central banker facing downside risk to growth and upside risk to inflation, it's not a good place, is it?
No, I told you, mark your calendar for 2031. That's when the tape of this meeting will be released. It's fascinating. The tension in the room must have been through the roof.
Lisa, regime change. Totally different place for this Federal Reserve to be in compared to where they were before. And I remember earlier this week you talked about the contrast between now and the pandemic. And you made the point that in the pandemic, it was easier for the Federal Reserve because they knew what to do. Just respond with lower rates and buy everything. This time around, it's difficult to know how to respond to these kind of shocks.
And frankly, there still is a lot of disagreement about whether some of these tariffs are disinflationary ultimately down the pike. Right now, they have to not overreact at a time where they are very worried about unemployment rates going up because they know how scarring that can be for an economy and the sort of long lags that can hold.
I would point out that whatever anybody's politics, at any time you pick up your cell phone and you look at names 6, 7, 8 newspapers, including Bloomberg News, people are shocked, John, at the cacophony of headlines. I think the Fed is part of that discussion. They have to be incredibly ex post until they see those headlines work out, political headlines.
It's one of those meetings, Tom, where you can sort of create a narrative out of everything here, hawkish or dovish. I do think it's material and something we haven't talked about just yet. If you look at the forecast for core PCE, yes, they had to revise that higher for this year, but I think it's notable. You really start to gauge how the Federal Reserve feels about if there is an inflation shock, how long-lasting it will be. Now, I don't expect them to use the T word later on in this news conference, but it's implied in the forecast. They're looking for 2.8% in 2025, relative to the previous projection of 2.5%. But then you look at 26 and 27, unchanged at 2.2% and 2.0%. We're trying to tease out what they really think about policy without them telling us what they really think about policy. And I think that's one way of doing it.
So let's translate this. What this means is that there's initial adjustment up in prices with the tariffs, with some of the other trade tensions, with slower growth coming down the pike that limits demand because the supply is not going to be somewhat constrained or more expensive. And then you get disinflation because they have to ultimately lower their prices. This is what they're trying to gauge out. What their role in this is a lot less clear.
Is that another way of saying transitory in those forecasts, Bob?
John, you know what's amazing? We're 2 months into an administration that's creating this volatility. The Fed and we have 3 years and 10 more months of this to go. Think about that.
Yes. They've still got to wait for April 2nd. The big changes come at the start of April.
So this is really something they have to deal with. How do they signal steady, calm, predictable hand at a time when everybody's heads are spinning and they cannot react too quickly? That is going to be a difficult thing to message, given the fact that a lot of people are saying this has to do with policy changes that haven't been firmed up, that are still negotiations more than just pure policy.
We're beyond the world where you can provide forward guidance. So we're not expecting sort of clear clarity on any forward guidance, but this is the kind of world where you need to clearly establish the reaction function. How will you as a committee respond to certain scenarios? That's what we want to hear in this news conference, I think, and that's what we want to see from the chairman when that news conference begins in about 60 seconds' time.
And what you're going to get is some people thought this, some people thought this. Chris Waller dissented because he might be or might not be in the running to be Fed chair. This is going to be a very difficult messaging act for Fed Chair Jay Powell, especially given the flipping and the flopping from December to January.
Governor Waller can speak for himself. I'm sure he's got other ambitions that maybe Chairman Powell doesn't want to talk about in this news conference. Bob, you're always fantastic about this. What would you ask the chairman in this news conference? If you had a seat in that room right now, what would be top of mind?
I'd ask him what the Fed is watching to gauge inflation expectations.
What do you think they are watching? Because it doesn't seem to be the survey data. Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
I think it's a combination of both, and I think it's also going to do from their survey of small and mid-sized businesses, see what they're going to do with the price increases and see how much of those they'll push through.
How much weight they put on all of this will be incredibly important. The chairman of the Federal Reserve with a very challenging news conference. That news conference begins right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place. to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation, too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with, you know, people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers just, you know, they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, you know, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. You know, we haven't had real price stability fully reestablished yet, and we have to keep that in mind. And you know, we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is from each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being And I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero. And you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And, I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change. And in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth? And do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon. Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to our uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing. for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was actually the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again. And that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month. And we think it was a good play. And as I mentioned, well supported. Thanks very much.
He can't wait to get out of there. Chairman Powell, fascinating news conference, the most interesting news conference we've seen with the Fed chair in quite a while. Let's start with the price action. A big portion of uncertainty with a sprinkle of transitory. Equity markets rocketing. We're up by 1.5% on the S&P 500. On the NASDAQ, up by 1.9. On the Russell, up by close to 2. In the bond market, 2-year, 10-year, 30-year yields down and down hard at the front end of the curve by 5 basis points to 398. Check out the commodity market. Gold, all-time highs. Intraday up by about 1/3 of 1%. There's a couple of interpretations here. Here's one. It's the bad news. So they've downgraded the outlook for growth, but haven't responded by projecting additional cuts. Here's the good news, and this is what the market seems to be leaning on just a little bit more. And the Fed chair spoke to it. Based on the forecast, the Fed believes that any upward revision to inflation in 2025 won't last beyond 2025, into 26, into 27. On that and more, take a listen to what the Fed chair had to say.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
A willingness to look through this, perhaps reinforced by this take on you, Mitch. Michigan inflation expectations reading is an outlier.
Okay, going back, there's a lot to unpack here. We can talk about Michigan, and how much that actually did or did not inform them back in 2022 and why it's less relevant now. The point about transitory is a key one. This market is looking through the downward revision to growth of stagflationary-like circumstances that frankly defy logic for why that should be good for risk assets, and point squarely to this belief that the Fed has resurrected transitory and is going to cut rates in the face of weakness.
Yeah, what I find fascinating is, John, you mentioned it correctly, to see gold go out to a record high 2/3 of the way through the press conference. Folks, I've never said that. And the technical destruction of the equity markets, to see the Dow and the S&P pop the way they are, by no means do they have some buoyancy of a buy signal. I mean, there's some damage out there from the politics folding into what he has to deal with.
The market reaction carries a lot of weight, and right now this equity market is rallying going into the closing bell about 40 minutes from now. Joining us on the program to react, the former New York Fed President, Bill Dudley. Bill, three-part act, we've wrapped it up. We've had the forecast, the decision, and now the news conference. What's your reaction to all of the above?
Well, I thought the summary of economic projections was actually a bit hawkish in the sense that they downgraded growth and pushed up inflation. And the dot plots, the dot plot did sort of shift up. But they didn't shift up enough to change it from 2 to 1 rate cut this year. But it did shift up. Powell then came in, and I think gave a pretty dovish performance in the sense that, we got this. We're in a good place. We can afford to wait. We'll see how it goes. We're going to get the job done. So he, I think, was pretty reassuring to people that this was all, quite manageable. I think the reality is, the growth outlook is worse, the inflation outlook is worse, and uncertainty is a lot higher. I'm not really sure how you parse that out as positive, but Paul put a pretty dovish spin on it.
Bill, that's where transitory comes in. It was resurrected, the word that was once left for dead, thought to look through some of the tariff-induced inflation, saying it probably would subside. What do you make of that? Because it's giving a lot of confidence to this market.
Well, one thing that he did talk about was inflation expectations, and he basically said, look, there's only one indicator that's really shown a significant increase in long-term inflation expectations. Everything else looks fine. So he's basically telling people you can ignore the University of Michigan long-term inflation expectations measure, which has shot up very sharply the last month or so. So that's reassuring. So I think people think Fed's got this. I think the reality is they're flying blind. They don't really know what's going to happen to growth. They don't know what's going to happen to inflation. And that increases the risk of making a policy mistake or just being late.
There's a book years ago, Bill Dudley, with a chapter by Bill Dudley and Ed McKelvey, and you said off of Patrick O'Brien, there's not a moment to lose. How exposed is this Fed? They're, to me, not a moment to lose. They are wait. Isn't that their best outcome?
Well, I don't fault them for waiting. I think when uncertainty is really high and and the economy is in a pretty good place. Inflation rate's running 2.5%, 3%. The unemployment rate's around 4%. Staying here, indefinitely would not be a really bad outcome. So I think that's what gives them the ability to wait, because the starting point is actually pretty good. The other thing I thought was interesting about Powell's remarks is he started to minimize the soft data that's showing a lot of weakness, and said we're really sort of focusing on the hard data. We haven't seen weakness in the hard data yet. So that was also reassuring.
This is what Marko Kolanovic, formerly of JP Morgan, has to say out on X this afternoon. Not in a hurry means we will drag our feet when things get worse, like in the fall of 2018. This is not bullish at all. Bill, you've lived a lot of this in the past. Is there a risk of a repeat of 2018 here?
Well, I just think there's a risk that the Fed will be late, because if you have to have the information in hand before you act, and there's long and variable lags of monetary policy, then you're not going to do the necessary action in a timely way. I think but at the same time, which way does the Fed lean? Do they lean against the inflation, or do they lean against the growth side? I thought it was interesting, the summary of economic projections also didn't get a lot of attention, but people's assessment of uncertainty about inflation and employment both went up. Their assessment of risk to inflation and employment both went up. And I think that's really what tells you what's bad about the economic outlook now, is that this dispersion of possible outcomes is pretty wide, and we just don't know which way we're heading.
Bill, you said that this is a Fed that's flying blind, and essentially Fed Chair Jay Powell said as much when he was asked why there was this ongoing 2 rate cuts priced into a market where you had some pretty sizable changes to growth and inflation. And he said, what would you write down? It's really hard to know how this is going to work out. Is there any time in history, Bill, that you can think of where the Fed was as flying blind as they are right now?
Well, I'm sure there's been other times. For example, when you had the 2 oil price shocks in the 1970s, that wasn't very good. You had the great financial crisis in 2007, 2008. Lehman Brothers failed over the weekend, and then the Fed was meeting the next Tuesday and Wednesday. So that was probably a pretty flying blind moment. So I think there's been other times like this. The good news is that your economy, as Chair Powell made it clear, is starting from a pretty good place. And that's the important part.
John Farrow, David Rosenberg, just out on Twitter right now, really has, and this is the insight that I had with Bob and Michael before, a 4.4% unemployment is a single stick, 100 basis points above the 3.4% low. You got to go back to 1948 to see that abruptness without a recession.
So we had some deterioration last summer, Tom. I'm with you, but it turned out to be a head fake.
Yes,
and the Federal Reserve was somewhat unnerved by it going into Jackson Hole and signaled some reaction to it, Lisa, and they followed up with 100 basis points of interest rate reductions, and here we are again. And we're trying to figure out if the soft data and the deterioration we've seen in the survey data is a head fake or not, and whether it will translate into softer hard data down the road.
And it seemed like this was a Fed more willing to say maybe it is a head fake with respect to the soft data and not necessarily emphasizing it as much as, say, the hard data, at the same time reducing their forecast I wonder if we're making too much of the dots. I wonder if we're making too much of all of these utterances when essentially you have a Fed chair himself saying, we have no clue.
We don't know.
We don't know. Inertia, we kept it the same because what are we supposed to do? And so there is this element where you have to look at this and say, on a fundamental level, is monetary policy still in the driver's seat at this point? Or is this a fiscal policy-driven market and, frankly, an economically driven market that the Fed cannot really engage with in a constructive way?
So, Lisa, in moments like this, I wouldn't put too much weight on the forecast because the chairman is telling you we don't know. I'd put a lot of weight on the communicated reaction function, how they're communicating, how we'd respond to certain information points. And Bill, I wonder what we've learned today. If we did get a deterioration in the economic data over the next several months, in the hard data, have we learned that this Fed would respond to that? Or would this Fed wait? Because I think that's critical for a lot of investors. Are they constrained? Is the easing bias now constrained by the inflation uncertainty of the next 12 months?
It's definitely constrained to a degree. I think the thing to focus on is the unemployment rate. If the unemployment rate stays where it is, then the Fed can wait. If the unemployment rate goes up to, say, 4.5%, then the Fed has to worry about the whole thing giving way. So I think the tightness of the labor market, how the labor market is performing is really important. And that itself has a lot of uncertainty because, remember, the growth rate of the labor force this year is going to be much, much slower than it was in 2023 or 2024 because very little in migration. Deportations, so a big slowdown in the labor force growth. So what that means is you can have slower growth and not have much change in the unemployment rate. So I think the unemployment rate is the summary statistic that I'd be focusing on.
I agree with that, Dr. Dudley. And my question is a 4.4, 4.5% U3 unemployment rate, is that the same as a U3 unemployment rate of 10 or 20 or 30 years ago?
No, I mean, I think the unemployment rate consistent with full employment has come down over time. Part of that's due to the aging of the population. Older workers are employed at a higher percentage of the time. So I think, the Fed's view is that we're basically at full employment right now, 4% or so. But if we go up to 4.5%, the Fed's going to be starting to worry that this whole thing is unwinding in a bad way. And then they'll, be really assessing, is if inflation bad news transitory, or is it getting into inflation expectations?
It's difficult to say with that in mind, Bill, that this Federal Reserve is in a good place. Do you think it's in a good place?
Well, they're in a good place in the sense that the economy, the starting point for the economy is in a good place. They're not in a good place in the sense that they're being hit with shocks that are bad for growth and bad for inflation, and they don't really know what the policy is going to be yet. So I think they're not in good shape in the sense that, let's put it this way, they like where their car is sitting today, but they now have to drive down the road in a very big, foggy environment.
Hey, Bill, thanks for helping make sense of it. Appreciate it. Bill Dudley there, the former New York Fed president. Lisa, after a conversation like that, you wouldn't have guessed the equity market is up by 1.2% on the S&P.
I don't understand in any way why a stagflationary environment would be positive for risk assets. I think that was sort of what Bill Dudley had to say as well. You raised a point, though. If this is a Fed that still is going back to the transitory idea and believes as their base case that these tariffs are going to have a one-time inflation ramification but that will die down, then why wouldn't they be more inclined to cut rates in the face of weakness? And that goes to this dovish aspect that's being reflected in markets.
Mike McKee joins us now. He's run out of the news conference to catch up with us. Michael McKee, the T word, makes a comeback in the news conference. What was your reaction?
Well, it did cause my eyebrows to go up a little bit, and I wondered if he had been warned against that. But seriously, you guys had the smart people on ahead of me, Bill Dudley and Lisa Abramowitz. I agree with both of the things that they said. Bill Dudley said this Fed is lost, and I think that is the case. They don't have any idea what's going on in the economy. And as Lisa said, you really can't believe or take seriously anything that they projected today because they don't know. This stuff has a half-life of the next tweet. So at this point, the Fed is just trying to reassure the country, which probably explains what we're seeing in the markets today, is that Jay Powell sounded like he was reassuring, but I wouldn't take any message out of this. Everything that he said after good afternoon, I would sort of put to the side.
What did you make, Mike, of his complete dismissal of the University of Michigan sentiment survey?
Well, that's a kind of standard thing for Fed officials. The old, we watch what they do, not what they say. And people have, the inflation numbers in these surveys have been distorted a lot in the past because people don't really have a good handle on what the inflation rate is. They just know their grocery prices are going up. So I can understand why he said that. And it was just a 1 month move in the longer run. The shorter run has moved up for a couple of months. So I think this is maybe a little whistling past the graveyard in terms of not trying to give the impression that the Fed is worried and going to have to take some action.
Mike McKee, appreciate the update, sir. Looking forward to your coverage throughout today and into the weekend as well. Lots to process here. Equities up nicely by 1.2% on the S&P 500. That bounce continues. With us around the table to close things out, Amanda Lynham of BlackRock. Amanda, where to begin? It's a lot to process here. One thing we haven't talked about enough, and Lisa mentioned it coming into the decision, a reduction in QT. How important is that to this market?
Well, good afternoon. Thank you for having me. Two things jump out to me. One is going back to the growth inflation mix being more challenging. A lot of this was baked in heading into this expectation. And so I think that's part of why we're seeing the market reaction. We've had just such a bruising few weeks in the equity market. Most forecasters have reflected a lower growth and higher inflation. And I think that's part of what's driving this here. And I would just underscore something that Bill Dudley said, which is I think this just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. And so really that 1.7% growth in the SEP, slightly below trend, that really has to hold up for risk assets to validate this move because the Fed's telling you that they can't respond. As it relates to QT, I think maybe that's why you're seeing some modest relief in longer end yields in the bond market. I think on the margin that could be somewhat helpful versus the counterfactual, but I don't think it's the main driver. I think the main driver here is that a lot of this bad news was baked in heading into this expectation. A more challenging growth inflation mix is the base case, and I think it warrants some widening in credit spreads.
Do you think it's positive that he resurrected the transitory word?
I think it was accompanied with a healthy dose of we're not quite sure what's going on.
Was absolutely
I think the market is kind of looking through that. But from my perspective, his kind of reinforcing that the labor market is still in a solid place is to me the key thing. Because if you think what's driving the resilient growth that we've seen over the past few quarters in the U.S., it's the consumer in aggregate. If we have a higher layoff rate, so if corporates start to be concerned about margins, they flex that layoff tool more aggressively, which is still quite low. That's a situation where that weakness that's so far confined to the low-end consumer could extend more broadly. So what to watch? Micro-level commentary, high-frequency data on the labor market, capital markets functioning, right? Like the idea that corporates can issue just at a higher cost, that's fine for market functioning. I think where the Fed starts to get concerned is if the markets are frozen.
There's also this question of the long end of the yield curve and why it should go down if this Fed is biased to looking through any inflationary shock as simply near term, if that is their base case, and we will not know for a longer period of time. Does that raise concerns about longer term entrenched inflation, especially at a time of global fiscal releveraging?
Absolutely, and I think our base case is that longer end yields are structurally higher, right? So that's the view across a variety of platforms at BlackRock, and I think right now, what we're seeing is that treasuries are not a reliable hedge in risk asset underperformance. And so what you've seen to a certain extent, treasuries can rally when there are growth concerns, but it kind of peters out at a certain point. And really, for rates to rally significantly, you actually need to have more valid recessionary-like concerns. You can't just have a growth slowdown. So what we're seeing is that it's almost like a quasi-hedge, but it's not a firm hedge. As for the inflation expectations, I do think it is concerning that they're not expecting inflation to get back to target until 2027. Similar message from the ECB, frankly, where President Lagarde said it's going to be a further path. When you think about the spillovers of German fiscal spending, right, higher bund yields, these markets don't operate in a vacuum, right? So equities versus credit or Europe versus US. And so I think we are bracing for structurally higher rates and structurally higher inflation.
If we have 1.7% and if we get the x-axis wrong and it extends, that tells me Republicans get tossed out of Congress just as one talking point. and there'll be huge pressure. Does it just devolve down to price up, yield down, and we go through 4%, as Bob Michael told us before the conference?
I think so. I mean, I think you asked earlier the unemployment rate that's really problematic for consumer credit. 5% is the metric that we're hearing that things really become problematic. But I think on the way to that journey, so when you start to get to 4.5%, I think you start to get concerning. It's the velocity of that move, and often these are nonlinear, right? So the deterioration happens quickly, as we've seen in prior cycles. I think that is very concerning. But to me, it really just hinges on, Chair Powell mentioned a low hiring, low firing environment. If that firing picks up, that's really problematic.
That's exactly where I wanted to go. Tomorrow morning, 8:30 Eastern Time, jobless claims drop. Help me understand the scenario. If we start to see some weakness there, how will markets respond to that? How will we think about the Federal Reserve's response to it?
I think markets have front-loaded it a bit. You've seen some widening in credit spreads. European credit is still holding in well, so I think that points to the U.S. concern. From my perspective, the Fed, though, is somewhat constrained in how they can respond to that given the inflation backdrop. So I think that's why the deterioration in the growth backdrop is so important to monitor, and it's also probably more critical than it was even a few months ago. Because a few months ago, the expectation was inflation will continue to cooperate. If further progress on inflation is delayed, then you somewhat have one hand tied behind your back in terms of I guess the question is, how much of a growth deterioration needs to occur before the Fed can react? And it seems to be that the bar is pretty high for that.
That's another way of saying bad news is bad news. If it is bad news over the next few weeks.
Especially when accompanied with even near-term inflation, I'm just struggling to understand what kind of offset they can provide by cutting rates at a time where inflation is a concern. I just keep going back to that. And this question about how supportive that will actually be. I guess that if the news is bad enough and they cut rates, it'll still be bad, but you also might get a little cheaper borrowing costs.
This goes to the wait and see. Confidence was a word that came up in that news conference. How long before you have any confidence? I'm not sure anyone can have any confidence right now. How long do they have to wait before they see?
Well, that's what I think makes the high-frequency data so valuable. And as we saw during the pandemic, it was the company commentary that actually shined the light on how pervasive the supply chain disruptions are. I think this just underscores the point. You have to be invested for a wide range of growth, inflation, and policy outcomes. All right, so it's not even just the growth inflation mix, it's the policy mix. So incorporating floating rate exposures, real assets, inflation hedges, those are all things that are really valuable, because I think there are just so many paths on this probability tree that we really have to position for all scenarios.
When we were coming into 2025, there was this belief that we have on one hand a Fed put and on the other hand a Trump put. Trump put still out there as sort of a question mark. The Fed put, people are saying, well, maybe they're going to be willing to step in. Can we really frame the issue in that kind of way? I guess that's sort of the fundamental question of today, where the market's treating a dovish response from the Fed as being positive for risk assets. Is that the new paradigm? Is it the old paradigm?
Yeah, the one thing that jumped out to me from Chair Powell's comments, previously he had talked about that they would respond to an unexpected weakening in the labor market. If the now base case is 4.4% unemployment, then it seems to me like you'd actually have to have something beyond 4.4% unemployment to step in and respond to that. So I guess it's saying that the bar is actually high, because right now they're telling you that they're expecting some weakness in the labor market beyond that.
Unlike the three of us, you went to class on Friday at Villanova years ago. We remember this well. When you study stagflation or hints of stagflation, there's a point where every central bank has to choose price change, finance, or jobs, jobs, jobs. I see no indication of anything, but they're going to capitulate to a higher unemployment rate down the road and ignore the rate markets. Is that the way you read it?
I mean, I think that's what their forecasts are telling you, is that they're baking in some deterioration. And so what does that mean for risk assets? A stagflationary environment is unquestionably negative for risk assets, because in that scenario, you have a bit of a double whammy of wider spreads and higher rates.
We don't do logs this late. We've all been up since 5 a.m. or 4 a.m., but the answer is it's nonlinear, is it? That's really what we're talking about.
Right. And
that wasn't in the press conference.
I think that's right. And I think when you take a step back, yes, we've had some widening in credit spreads, but all things considered, we're still really tight. And so we're baking in an expectation for an ongoing rebuild of risk premia. So I think the market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening in credit spreads. And we would view that as an opportunity. And I heard your conversation with Bob earlier. There is a lot of demand on the sidelines. So I think being opportunistic is really the key to taking
You're seeing the same thing? How much appetite is there for fixed income?
We are. And I think I would say save for the lowest quality pockets of the market, where, for example, CCC interest coverage is still below 1 times, and so that's a very tenuous place. But foreign demand, yield-based demand, long duration spread product, high quality spread product, the U.S. is the largest, broadest market for that. And so there is a significant amount of demand. But I do think there needs to be a rebuild of risk premia, given this is unquestionably a more challenging growth inflation mix.
Where is that money coming from? Does it come at the expense of risk assets like stocks? And I speak at a time where Howard Marks of Oaktree came out and said he prefers credit right now over an equity risk, because you are getting income and you have a greater degree of certainty.
And you're higher in the capital structure. And I think maybe one of the understated themes of the past few quarters or maybe past few years is that corporate bonds, because of the higher interest rate, are throwing off more cash just on an ongoing basis. And so just reinvesting that cash is something that's important. Foreign demand has been a big tailwind. I will say on the margin, we are bracing for some of the foreign demand for U.S. dollar credit to, over time, perhaps be repatriated back to European markets now that European yields are quite attractive. And so on the margin, that's something to watch for. But again, these risk assets don't happen in a vacuum. But I do think there's a significant amount of demand, whether it's coming from equities, it's coming maybe from different parts of foreign markets.
I mean, one thing we haven't talked about here, we got BlackRock on the desk here. I mean, John, it's just simple. BitDog moonshot out to 85,000. I mean, these are the indicators that technically it's not telling me anything, but I'm sorry. You're going 78,000 to 85,000.
Gold signals something too. What are we seeing there from crypto, from gold?
I think that's diversification. I think that's the market saying that perhaps...
come on, it's fear.
I think the gold is perhaps central bank buying, some other dynamics going on there, but I think a big part of it is portfolio diversification, real assets, inflation hedges, uncorrelated exposures.
Oriental rugs?
The stagflationary backdrop that we suggested, the 60-40 portfolio wouldn't fare that well in that sort of...
That sounds personal.
She's a machine. I love
sounded personal. Who's been forcing you to buy rugs?
I'm looking at this. I don't have any technical veracity on Bitcoin.
Wait, is that hold on a second, pause. Is that your Haven trade? Oriental rugs?
My Haven trade is tuition. Okay, let's leave it there.
Finally found out what's happened with a triple leverage cash flow. It's been going to rugs.
Oh my gosh.
I'm just upset BlackRock. I was in syndication with them. They wouldn't go for triple leveraged all cash.
Amanda, appreciate your time. Fantastic. What a moment. Amanda Lynham there of BlackRock. Perhaps we're being fast and loose with the S word, stagflation. We're looking for growth close to 2% and inflation anywhere between 2.5%, 3%. But it's the mix. And this is what Amanda was talking about. The mix here. This is the challenge the Federal Reserve is facing. It is the central banker's dilemma. Typically, the kind of dilemma you see in emerging markets and not in developed markets. Downside risk to growth, upside risk to inflation, and a Federal Reserve uncertain, low on confidence, and not sure what to do.
And that's the reason gold is really telling us something. And that is this real question about whether the United States, with the policy mix and the monetary policy backdrop and inflation where it's coming from, can avoid a stagflationary-like spiral, not necessarily stagflation of the 1970s, but an environment that makes it more difficult to repay a debt load that's causing a lot of concerns for a lot of people.
Peter Fisher taught me this. Get your hands out. He says, on radio it doesn't work. We're going to go with this. The answer is here on a nominal GDP basis. Today, the lower growth was balanced out by stagflation to a pretty much level nominal GDP. What happens to Amanda Lynham's call if we get nominal GDP to begin to compress? That's what's not in the discussion.
I'll tell you what this market's doing for the benefit of our TV audience, like this, up and to the right. Just sort of up and to the right. That's the story today. We'll see if this holds. We are positive by 1.5% on the S&P 500. Going into the closing bell. Coming up on the close, the team's going to take it over. They'll be catching up with the former Fed Governor, Betsy Ju. From New York City this afternoon, good afternoon to you all. Thank you for choosing Bloomberg. This was Bloomberg Surveillance.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. 14 minutes to go ahead of the closing bell on Wall Street. You heard Jonathan Farrow say it, up and to the right. The Dow, the S&P, NASDAQ, all very close to session highs right now, right to the numbers, with the S&P up 81. Fed Wednesday up 1.5%, 56.95 where we stand. The Dow surging 497 points, up 1.2%. The NASDAQ Composite Index up 1.8% with a 10-year 4.25%, the 2-year 3.98%. Gold up $11 the ounce, $63,046 right now on the precious metal, up by about 0.4%. Crude up 0.6, 67.28 a barrel on WTI, and Bitcoin now up 4.1%, 85,403 on Bitcoin. The big story today, you heard it live on Bloomberg. Fed officials held their benchmark interest rate steady for a second straight meeting, though they telegraphed expectations for slower economic growth and higher inflation. Here's Fed Chair Jay Powell from the statement.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
Fed Chair Jay Powell again live on Bloomberg Radio. So recapping, we've got the 10-year right now, 4.25%, the 2-year, 3.98%. Stocks higher heading into the close with the S&P right now up 79, up by 1.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
And a very good afternoon, everybody, live on radio, TV, and Bloomberg Originals, also YouTube. Actually, we're going to be on TV in just a moment. We're going to head over to our TV colleagues. I'm Carol Massar at Bloomberg headquarters in New York City. And, of course, Tim Stenovec, you're out there on the West Coast.
Hey, you're on a TV here, Carol Massar. And if you're watching on YouTube, you can watch us on TV if you want. What a Fed meeting.
Yeah.
What a market reaction.
Well, listen, I think it's so interesting to hear the conversation that the gang, the surveillance gang, really just having on television and radio about, was it hawkish, a little bit hawkish? Was it dovish? We certainly saw equities rally. We're coming off our best levels of the session, but nonetheless, Tim, we did see that immediate market reaction. Stocks moved up. We saw yields back off. I feel like I can't wait for the May meeting already.
Yeah, I'm already looking forward to that. And we're going to get a lot of data between now and then, too. Carol, as we heard from Charlie, the Fed, as expected, held their benchmark rate steady for a second straight meeting, though they telegraphed expectations for slower, Carol, economic growth and higher inflation.
Did indeed. Jay Powell saying the U.S. economy, folks, it is strong overall, and yet there are some signs of moderation.
Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment.
That, of course, was Jay Powell at the press conference today, a little bit earlier. As for market reaction, as we mentioned, we did see stocks rally and U.S. Treasury yields back off right after the decision. Let's get more, though, on what we heard from the Fed today and what we saw in terms of market reaction. Keep in mind that we're going to be covering all of this over the next hour and a half. With us is Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey and Veronica Willis, Global Investment Strategist at Wells Fargo Investment Institute. Ira is at BI headquarters in Princeton, New Jersey. Veronica is in St. Louis. Hey, Ira, I want to start with you. How did the Fed do, you think, on messaging and in assessing today's current U.S. economic backdrop and what it needs in terms of monetary policy? And I am curious, did it feel more hawkish? Did it feel more dovish? What was your read?
So, well, we have a natural language processing model that parses all the words and language from all of the opening statements. And this one was incredibly neutral. And it had been somewhat dovish last month. And, being as neutral can be, it was a little bit surprising maybe to see the Treasury market rally a little bit and also bull steepen. So before the Jay Powell started to speak, Treasury yields were higher by a little bit on the day, and then we rallied about 10 basis points in two-year yields, soon after he started to speak. So the market certainly took him as dovish. He wasn't hawkish by any stretch of the imagination. The one thing that I think is interesting is the dot plot. And, we thought that maybe the median dot would move down a little bit. It didn't. It stayed the same. So this is pretty unusual for the market actually to rally like it did, or the rate market to rally like it did when the Fed didn't move the dots.
Well, Ira, I wanted to talk a little bit about that because it didn't seem like there was any certainty with regard to the Federal Reserve's economic outlook. We heard as much from Mike McKee on Bloomberg TV and Bloomberg Radio a little earlier. The Fed doesn't really know where we are. Why does the market think it knows where we are?
Well, the market has to price something, right? So I think that the market probably took what the Fed said, not so much that that they're necessarily the Fed's going to be hawkish or dovish, but I think one of the things is that the market might be thinking, hey, the Fed might make a policy mistake here because we are seeing a slowdown, but the Fed and the Fed dots are suggesting they're not going to cut rates very quickly, and certainly not in the near term. And you really saw that rally pick up after Jay Powell mentioned once again that he thought that they could that they could be patient and they didn't have to be in a hurry. I mean, the exact words were, "We're not in a hurry to make a rate adjustment." So that means we're here probably for another 3 to 6 months at least on the Fed funds rate.
Veronica, I want to bring you into this conversation. In terms of markets, we've just been talking about this with Ira. I mean, we certainly did see equity markets rally. We're off our highs of the session. What's the investor read on this decision, Fed commentary? Do you feel like investors have it right? And has anything that we got from the Fed chair and from the FOMC today in its decision and commentary and revised outlook, has it changed your investment outlook?
I think that investors are really looking at the kind of best case scenario where growth is going to slow enough to afford the Fed to do, 2 or more cuts this year. And I think that's a little bit too optimistic. So the market may have been a little bit too optimistic today in response to this data or in response to what the Fed has said. And I think that it's, more realistic to expect maybe 1 cut this year. And I think that the risk is a little bit more on the side that there might not be a cut this year versus 2 or more cuts. So I think it's just another example of the market kind of taking what it wants from what Powell says, taking what it wants from what the Fed has shown us, and hoping for that best case scenario.
I mean, what was the most important part of what we got from the Fed chair, Veronica, in your view today?
Yeah, I think what was really interesting were his thoughts around the consumer and how that might impact future economic data. I think that's something that's becoming more and more important, just considering how important that consumer spending is to driving our economy. And so the Fed is watching really closely all of these sentiment surveys that have come out with consumers feeling uncertain about their ability to continue to spend. We haven't necessarily seen that flowing through very strongly in any of the hard data, but it's something we're watching very closely, and I think it's something that the Fed is watching very closely as well.
Hey, Ira, come on back in here. Given what we heard from Fed Chair Jay Powell today, and we think about sort of the upcoming economic data that we get, what is the next catalyst that you have your eye on?
So, we're like in this weird place. So we do get the PCE deflator next week. And, I'm not sure that that's really going to matter a whole lot because we kind of know what it is, given we've gotten the inputs to that. So it's going to wind up being things like some of the survey data, the ISM data that we get in 2 weeks, plus the payroll report, obviously, is the big one. I think something else that's going to be interesting is the implementation of the slowing of runoff. So, it hasn't gotten a lot of attention, only had one question at the very end of the press conference, but the Federal Reserve is again having the amount of quantitative tightening it's doing, and it's only going to have about $20 billion of runoff come April 1st, and I think that that's something that is kind of flying under the radar, and how will that affect liquidity in markets once that's implemented, I think will be an interesting thing to look out for.
Are you already looking forward to the May meeting, Ira?
I look forward to every meeting, but we get the minutes between then. The minutes will be really interesting because there was a lot to unpack in this meeting. So the minutes could be really an interesting read when we get them in 3 weeks.
I was going to say, Carol, he's not as boring as you and me, where we're just like already looking forward to the May meeting. Hey, Ira, before we let you go, what was one question that you didn't get answered from Jay Powell today?
yeah, I think it was a little bit about about the balance sheet and how they see the balance sheet reacting with the economy. He has been asked that before, but it's been a little while, and given that they did take action today by slowing the pace of asset runoff, I think that can be pretty important. And he wasn't asked about the other side of the balance sheet, right? So the asset runoff occurs, and then eventually we're going to have a time when there's not enough liquidity, and we know that there's been issues with the standing repo facility and some of the ways that they conduct liquidity activities and actions, and he wasn't asked at all about that either. So I would be really interested to, kind of dig into those weeds, because this is the plumbing of the entire financial economy that we have. So if the financial economy, the repo market, and the funding markets break, everything else comes crashing down, as we saw in 2008, right? So we have to make sure that the Fed has the tools in order to handle that once we get to the lowest comfortable level of reserves.
All right, we're going to leave it there. So much appreciate both of you and your views on all of this. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey and Veronica Willis, Global Investment Strategist at Wells Fargo Investment Institute. Our thanks to both of you as well. Obviously, our big story, what the Fed did, and what's to come, and how the markets read this. Right now, though, folks, just got about 2.5 minutes left in today's trading session. Heading over to our TV colleagues. The closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele and Scarlett Fu taking you through the closing bell in a global simulcast. We're joined now by Scarlett Masser and Tim Stenovic, bringing together our Bloomberg Television. What are you laughing at me?
Scarlett Masser. Love it.
I said Carl Masser?
I would gladly be part of your family.
Did I say that?
Maybe I heard wrong. I'm egotistical like that.
Okay, I definitely could have said that. I didn't have my best day on radio today. We're going to take you through the closing bell and all the pivotal key moments on radio and YouTube and TV in a global simulcast.
There you go.
Well, whatever. Anyway, there was a rally, guys. It's the best day for the S&P on a Fed day since 2022. Whew.
I know. It's kind of interesting. I love the commentary. A little bit hawkish. Is it a little bit dovish? I mean, equity markets definitely moved up higher on it. We saw yields back off. As we were just kidding with Ira Jersey in our conversation, I'm already looking forward to the May meeting to see kind of where the Fed goes. A lot to get to, though, before we get there.
Still off our best sessions, our best levels of the day. Interesting to see this, at least equity market reaction, given the uncertainty that Jay Powell communicated during the press conference. It doesn't seem like he really understands or knows where the economy is or where it's going. Mike McKee said as much post-press conference.
Yeah, my takeaway from this news conference, even though he sounded really reassuring, he looked really reassuring, was that nobody knows anything. They don't know. They don't have a clue. In the same way that perhaps the president himself is not quite sure what he's going to do next.
What I did find interesting is that he finally sort of walked through what would make this tariff headlines become less noise, and that's that housing services inflation, not through goods, not the non-housing services inflation, but very specifically, this is something to definitely watch. All right, there we go. We are wrapping up the closing bell on this Fed Wednesday. S&P up by a full 1 percentage point, the best day for the S&P on a Fed day since 2022. The Dow following suit up by about 1%, and the Nasdaq outperforming up by 1.5%. Guys, it's broad, equal weighted, mid cap and small caps.
Gotta love that. Just digging a little bit deeper into the S&P 500. Most names in the index higher today, guys. 367 actually gaining some ground. 133 to the downside. 3 Scarlett unchanged.
All right, and the relief in equities, you see it across the board here. Let's look at the IMAP, which splits up the S&P 500 into 11 groups, all green, although it should be noted that the defensive sectors, healthcare, real estate, consumer staples, utilities, those are the laggards. They've gained the least. In fact, those 3 groups, staples, real estate, and healthcare, basically unchanged to up 0.1%.
And they were just getting going. All right, so much for that. All right, let's get to some of the individual gainers. Boeing, guys, number 1 gainer in the S&P 500, a gain just shy of 7%. Company came out, said cash outflows are likely to be smaller than forecast this quarter, with cash burn, quote, could be in the hundreds of millions of dollars, better than expected. They went on to talk about their factory operations stabilizing, production of the 737 going pretty well, and a shadow factory for previously built 737s likely to be wound down this summer. So some good news out of certainly a company name that has been really pummeled for a while. Taking a look at Roku, up about 7%, up as much as 10% earlier in the session, but still finishing with a gain of more than 7%. This stock jumping after Trump Media and Technology Group launched its Truth Plus streaming app on the Roku channel store. And I should point out, this is despite Guggenheim coming out and cutting its price target to $100 a share from $115. Stock closing at around $72 a share. One more for you, Signet Jewelers, man, on a tear, up nearly 25% at its highs today, finishing with a 17% gain. The owner of K Jewelers touting a solid start to the fiscal first quarter, issued an annual outlook that Citi's analysts described as better than the market feared. You might remember, company had a tough time the holiday season. It was pretty weak. That led Wall Street to slash expectations for the company. Company does, though, say sales are rebounding after that weak holiday season. Stock, though, Tim, still down about 30% year to date.
Hey guys, I just want to jump in real quick though, because
ahead,
Five Below
Alex.
is out with earnings, and that's always a fun one to look at, Tim. So we're looking at the full year for forecast for net sales, actually coming in pretty well. You're looking at the high end about $4.33 billion, and on earnings you're looking at about $4.52 a share on the high end. All of that, at least on the net sales, that beat estimates. The earnings fell a little bit short. For the first quarter though, same thing. It seems a pretty solid quarter for net sales as well as EPS. Five Below, though, it's like it has all that cheaper stuff. I definitely go there to shop for my daughter's birthday. So it's going to be interesting to see sort of what they say on tariffs on the call.
All right, Five Below shares kind of bouncing around a little bit in the after hours. I do want to get to some of the decliners in today's session. Intel actually snapped its 5-day winning streak, falling by 7% today. This after a TSMC board member dismissed a report that TSMC had pitched to major U.S. chip makers about taking stakes in a joint venture that would operate Intel's factories. We're talking about Liu Qin-Cheng, the minister of Taiwan's National Development Council, also a board member at TSMC, said that he could state, quote, with certainty that the TSMC board has never discussed a collaboration between TSMC and Intel. This is according to a report by Taiwan's official central news agency. Still, Intel shares up 20% so far this year. I'm also watching what's going on in one pharmaceutical company, Gilead, shares falling today by 2.5%. This after the Wall Street Journal reported that the U.S. Department of Health and Human Services is weighing plans to cut federal government funding for domestic HIV funding, citing unidentified people familiar with the matter. Analysts said that while the headlines were negative for Gilead, there wouldn't be too great of a hit because the potential cuts wouldn't impact access to those drugs. Gilead does make drugs that prevent and treat HIV, such as Truvada and Descovy. And finally, General Mills shares fell today. The company did report third quarter organic sales declined by more than expected. Shares fell by 2%. It's yet another a sign that the slowing consumer spending is happening in the U.S. The company, Alex, also cutting its full year forecast and its organic net sales forecast for the full year.
So is it Gilead or Gilead? Just asking.
I don't know.
We don't know.
I said Gilead.
I think it's.
I said Gilead.
Is it Scarlet Masser?
Oh, shade has been thrown.
Yeah.
I received that. I accept that shade.
Wow.
That was great. Especially if I didn't even know I said it.
San Francisco has not softened him, huh?
No, it just hardens him up there.
Yeah.
Still the techie stuff.
He's a mean New Yorker in San Francisco.
He's a mean New Yorker.
Everybody here is smiling all the time.
He's from California, guys.
Yeah, but he's lived here for long.
Now he's in Park Slope, where all the mean people live. All right, taking a look at the bond market, guys. It's a bit across the board, particularly in the front end. You have yields down by about 6 basis points. I mean, it's hard to make a lot out of this action, right? I mean, is it just removal of the bad news? We're removing any risks of a rate hike. We're also not seeing an economy that falls off the cliff, like Jay Powell, clearly still optimistic about the state of the economy despite the risks. But take that for what you will. Also, positioning has been quite different also.
All right, guys, now that the Fed meeting is over, I think it's time for us to go on a road trip, a little class trip of this simulcast, and go to Denny's because they've got a new breakfast offering, limited time only, the NVIDIA Breakfast Bite. And it's about 4 sausages. You wrap it around a pancake, dip it in syrup, and Tim, right, it's just like Jensen liked it.
Wait.
Yeah, remember, do you guys know this, right? The origin story for NVIDIA apparently happened in a Denny's in Silicon Valley.
No,
so
tell us.
Denny's for years has been really harking back to that moment.
Or milking it.
For promotional materials. And this is no exception, especially during NVIDIA's GTC week. You can see Jensen there at Denny's flipping some pancakes.
So this is their newest collab with Jensen Huang? Like, it went
I
from
don't
like
know if
social
Jensen-
media influencers to Jensen Huang?
I don't know if Jensen, I don't know to what extent NVIDIA, I don't know.
It did happen at the GTC conference,
look,
and there are no chips in them, like
and he did say
Blackwell chips
in the
or
press
anything.
release, he said, Denny's will always be a special place for me. It's where I learned that no task was too small to do well.
Wait, refresh. So what is it? It's sausage.
4 sausages. You can wrap it in Denny's buttermilk silver dollar pancakes, then you can dip it in some syrup.
Yeah,
totally healthy.
All right, I'm into that, but
I'm into
it's
that.
interesting that it's called the NVIDIA Breakfast Bites, BYTES. BYTES.
Nice. Okay.
All right, you know, the other story that we're paying attention to.
Are you going to be serious?
Yes,
It
I
is.
am.
I'm sorry. The story's cool.
Well, we were excited about this morning when we saw it, which is Oppenheimer downgrading Goldman Sachs, Carlyle, and Jefferies because they're saying that the anticipated boom in M&A has not materialized and may never materialize. Now that it's pretty clear President Trump is really pursuing tariffs as opposed to some of the other let's just say loosening of regulation that a lot of people had anticipated.
Right, the phase 2, which would be lower taxes, as well as the deregulation. I appreciate this is not like a fun chat, but the idea that we're waiting for this M&A for a while and the animal spirits, if it doesn't materialize, not just pushed out, but doesn't materialize, like isn't that a big re-rating of what we need to think about?
Listen, these
What
private
about that
equity
32
guys. Oh, sorry, go ahead, Tim.
Yeah. Well, what about the $32 billion Google Wiz acquisition that was announced
That's
earlier
reviving
this week?
something that they were looking into. That's number one.
Yeah, but they were reviving it. One of the reasons they,
But
one of the reasons they
idea
were
that no one
reviving it
can-
is because a regulatory environment that might be friendlier, right?
But no one can plan ahead right now because nobody knows what's going to happen, right? Nobody knows anything. Yields are kind of all over the place, right? And nobody knows what the environment's going to be like. So they're all just like, oh, I'm paralyzed. I got to wait to see what happens.
Yeah, I was going to say, like all the private equity guys. I mean, M&A bankers have been waiting for Trump to be in the White House, thinking everything was going to be easier, we're going to get deals done, and then all of a sudden it's like all this volatility, and nobody wants to do anything. So yeah, it is. All right, it's a good story.
It is a good story. We've
Not
been
as
kind of
good
waiting
as
for
the
the first
pancake story.
for the first thing to fall, and it feels like this is it. This is the first downgrade here.
No, it's a really good point, and we'll see certainly when we get into the next earnings season, right? Like what the context is and the commentary. All right, guys, we are going to do this road trip. I could totally see us all getting into this sandwich.
NVIDIA Breakfast Bites, here we come.
All right, that's a wrap. Across platform on radio, TV, YouTube, and Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody. Carol Masser, Tim Stenivek. Tim out there on the West Coast. I'm here on the East Coast. Tim, you know, we think about Ryan Dietrich a lot, and we've been hoping to catch up with him, so we're so grateful that we're going to get to him in just a moment, because we just want to remind everybody, he has been a U.S. stock optimist, and right in his market and recession calls for the last couple of years. He nailed it back in 2023, also 2024, and when we talked with him in December, he said the bull run had more room to run.
He did, however, early last month note that history shows us that as an Eagles Super Bowl victory could tank the stock market, something that was making the rounds on social media. It did note, Carol, that success for Philadelphia sports teams has previously been followed by troubled times in the U.S. economy and markets. I mean, how do you even make sense of this stuff? It's like, talk about somebody who, like, you know, reads astrological charts.
I don't know. I think, you know, you never know where the market can take its cues from. So, all right, let's see what Ryan has to say. He is back with us, and he is Chief Market Strategist at the RIA and also Platform for Advisors, the Carson Group. He is with us. Where are you, Ryan, today?
Cincinnati.
Cincinnati. So tell us, the Eagles won. Are we doomed?
Well, that's a playful one. We don't blindly invest in that. But historically, when a team from Philadelphia has won the World Series or a Super Bowl, trouble has come for the stock market. You're talking 2008. You're talking the early 80s double recession. You've got the crash of 29 in there. Now, that's playful. You know, we're not getting too worked up on that. But the big question is this surprising, right, that we had some volatility? Yes, I've come on for a while saying we're pretty optimistic. But we've been also pointing out the first quarter of a post-election year is usually not that great. The first quarter after a 20% gain, usually not that great. The first quarter of the last 20 years, stocks are actually negative for the year on average until like March 16th, March 17th, right where we bottomed, potentially now. And I guess welcome to March Madness. I know this is the radio, but I think I'm on YouTube. I've got my Xavier shirt on. I'm a Xavier boy. I'm in Cincinnati. They play tonight in the first four up in Dayton. I'm going. We're going to take out Texas. Just wanted to say that. Sorry to my friends in Texas.
Okay. That's okay. You can make market predictions, and you can also make your bracket predictions as well, Ryan. So you did say, and I want to make sure you said this, you said that we did bottom for this cycle. Is that right?
Well, I mean, boy, put some pressure on me. But yeah, we think we did. I mean, listen, there's a couple ways to look at this. We had a regular 10% correction. Didn't have one last year, right? All the fear came up. When I took a look at previous 12 times, the market went into a correction, but did not go into a bear market. That's our base case. We do not see a bear market. Tim, 5 of those times, you bottomed the day you went into a correction. So that'd be last Thursday. And everybody was very bared up last Thursday, rightfully so, a lot of scary headlines. And then we had that back-to-back 90% up days on the S&P 500, so 90% of the stocks in the S&P 500 up 2 days in a row. That historically is quite bullish, right? 6 months later, you're up like 15% on average, higher 10 out of 11 times. That's just one data piece, but I think we had a buying thrust with extreme negativity, and now we're in the second half of March, which historically is pretty strong seasonally, and now we've got the Fed. Listen, you guys talked about it. I know we can talk about it a little more. Were they really that dovish? I don't think so, but I think it was a relief for the market, and clearly we saw what yields did and the market in general. But hey, we're not going to complain after the run we had.
Wait, so net, you also said we would be up around 20% this year in U.S. stocks, so you do still believe that?
Well, let's see here. What we
that was
came
back
out
in
with
December. That was back in December.
Well, understood. Yeah, we came out early this year with between 12 and 15% in the United States. So we think that's very likely still, Carol. Now, what we're doing with the money we run, well, we've been in gold. Gee whiz, I think April of 2023 added some more gold. We were very, very overweight U.S. stocks for a while. Came on with you, but we've kind of done some tinkering, if you will, with the models we run for our Carson partners. We've got some treasuries for the first time in a while. We do have about a 20% allocation to international stocks, but we are overweight equities, and still think that's the way to go. But we think the other parts can do well. But to answer your specific question, yeah, we think stock market. I don't know, we're down now after today's rally, 3 or 4% for the year. We think it can still hit double digits, which sounds like a long way away, but it's very possible.
Ryan, are you trimming gold and adding to international equities? Are you adding to U.S. equities right now? What exactly is your team doing?
Yeah. No, great question there. So as of now, no. I mean, gold is, it's a monster, and it's incredible how well it's done. What we've done, we've actually gone into some low vol, right? We sold some high vol stocks earlier this year, went into low vol, because again, as this cycle ages, maybe more volatility. To be honest, we weren't crazy about the mega cap, or Mag 7 is what I'm trying to say. Mag 7, I know, came on most of last year saying more neutral tech. Sometimes we get weird looks when we said that. But now we're seeing this rotation. And again, the lifeblood of the bull market is rotation, right? So tech isn't doing quite as well. That's okay. We're seeing leadership from other areas, but areas like low volatility, industrials, financials, we think those are going to continue to do pretty well. And honestly, they have. I know financials had that big pullback recently, but we still pretty optimistic that that's a group that's probably still going to lead is financials.
We just talked with our TV colleagues who we made fun of them, but, because we had a fun story to chat about. But they had a serious one about Oppenheimer cutting Goldman, Jefferies, and Carlyle on the M&A outlook, noting that the M&A rebound likely delayed or canceled. There were a lot of expectations coming into this Trump market environment and this administration, President Trump, that it was just going to be go, go, go in terms of the business environment and the market environment. It's not exactly playing out like everybody expected. I don't think, Trump first term is exactly playing out like Trump's second term, at least so far. So, if tariffs stay, if new policies come, if regulations maybe aren't so friendly, if M&A doesn't come back, I mean, is that a very different market environment then, in your view? And maybe your expectations for 12 or 15% gains on the S&P are not then realistic.
No, those are some great points. I will say, I heard you guys talking about Denny's and sausage and pancakes before I came on. I was kind of jealous. I didn't get to talk about that. I love Denny's. Anyway, but you get into it here, and I think what people thought when President Trump won was you're going to get a couple things, right? Deregulation, better taxes, and tariffs in that order. Well, we're not getting in that order, as we all know. So if the animal spirits is a popular word coming into this year, clearly those have been screeched to a halt, if you will, when you look at some of the sentiment polls, soft data sentiment polls and things like that. But again, I guess you could say we're optimistic that yes, we're all worked up over tariffs, and rightfully so. April 2nd, as everybody knows, is that big day. But the market, I think, markets can go up on good news. Markets can go up on bad news. I mean, 5 years ago right now, bad news. And
But there's good news, there's good news, there's good news, there's bad news, there's bad news. Do you feel comfortable in this market environment that we're not going to have a lot of surprises and unexpected things coming our way?
Well, put it this way, we do, because we're still overweight equities. In the unconstrained models we run, we're about 76% equities. 60% is considered, kind of right down the middle. So yes, we're overweight. And again, a lot of it has to do with that over-the-top negative sentiment. I'm sure other guests have talked about some of these things. We saw a huge put-to-call ratio spike last Thursday, but the one that AAII sentiment poll, I know there's some flaws in this one, but 3 weeks in a row, 55% bears, all right? We haven't seen that since the March 2009 lows. Just the random indicator I have, just hearing from people I haven't heard from for years that are very worried on what we're calling a kind of run-of-the-mill normal 10% correction you tend to see a lot of years. That could be bullish with those lowered expectations. And today, the Fed, were they really that dovish? Honest to goodness, I don't know if they really were, but they weren't hawkish, and the market liked it.
Ryan, 20 seconds left. What makes you change your view that this will be an up year for the equity index?
To turn us a little more cautious or negative, I think more of a spike in credit spreads, right? We are not seeing stress in the credit markets. Some, yes, but Tim, we're just simply not seeing that. There's less stress now than it was in in August when we had that very scary yen carry trade unwind. So that's the thing we watch. We're not seeing it yet.
All right, gonna leave it
Ryan
there.
Dietrich. Yeah, go ahead, Carol.
No.
Go Xavier.
Always fun, always fun. You keep us on our toes. Ryan Dietrich, Chief Market Strategist at the Carson Group. Hey, coming up, everybody, as President Trump seems to want to expand economic relations with Russia, one longtime risk advisor reminds us that doing business there is anything but normal. He's going to join us. He's got a new book out. That when we come back. I'm Carol Massar along with Tim Stanovic. This is Bloomberg.
421 on Wall Street. We do check markets all day long here at Bloomberg Fed Wednesday. Stocks higher, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Stocks climb. Bond yield slipped after Fed Chair Jay Powell reassured investors by signaling the Fed saw no need for drastic action in the face of tariffs and their impact on inflation. His remarks were carried live on Bloomberg Radio, and at the news conference he talked about tariffs and the outlook for inflation.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Fed Chair Jay Powell. S&P today up 60, up by 1.1%. The Dow up 383, up 0.9%. NASDAQ up 246, up 1.4%. 10-year 4.24% with the 2-year 3.97%. Spot gold up $11 the ounce to $3,045, up 0.4%. West Texas Intermediate crude up 5.1067.21 a barrel, and Bitcoin surged 4.6% today. Closing back in on 86,000 right now. Bitcoin at 85,805. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, so appreciate it. Thank you so much, Charlie. Carol Massar along with Tim Stenovic. I'm in New York. He's out there on the West Coast in our San Francisco News Bureau. Wanted to get to some of the big news of the day. President Trump started phone talks today with Ukrainian counterpart Volodymyr Zelensky a day after the U.S. president's conversation with Vladimir Putin failed to win Russia's commitment to a 30-day ceasefire in Ukraine. Now, earlier today on Bloomberg Surveillance on TV and radio, President Trump's special envoy Steve Witkoff said that he believes President Putin is operating in good faith and that an end to the war could be soon.
On Monday, we actually have the technical teams going, and why? Because that's what we're down to. We don't need to have the larger overarching discussions. That's been had, and it was completed yesterday between the two leaders. They agreed on a pathway to some ceasefire conditions today and to a full-on ceasefire that will be negotiated over the coming days. I actually think in a couple of weeks we're going to get to it.
Again, that's Steve Witkoff, President Trump's special envoy, earlier on Bloomberg Surveillance. We also heard yesterday from the White House, after that 2.5-hour call between Presidents Trump and Putin, the White House readout that the two leaders agreed that a future with an improved bilateral relationship between the United States and Russia has huge upside. This includes enormous economic deals and geopolitical stability when peace has been achieved. So the question is, can there be enormous economic deals, business deals between the two nations? And if this feels a little bit like deja vu, you are right. A new book out looks at just that and the recent experiment in capitalism from the 1990s until 2022, when global companies set up shop in Russia. Writing about that is Charles Hecker. He's a journalist and risk management consultant. His book, just out this month, is Zero Sum, The Arc of International Business in Russia. He has spent 40 years working in the Soviet Union and Russia, and he joins Tim and me on this Wednesday. So delighted to have you here with us. Charles, I do want to first ask you about what's been going on over the last couple of days and the conversations between the presidents of the United States, Ukraine, and Russia. Does this look like to you like lasting diplomacy being worked out, peace negotiations being worked out? What's your read, especially with your knowledge of Russia and Putin?
I think right now somewhere we're between sort of 2 steps forward, 1 step back, or maybe even 1 step forward, 2 steps back. I mean, from today's conversation between President Trump and President Zelensky, we can at least draw the conclusion that the two presidents are once again sort of speaking regularly, speaking normally, and without the anger and the hostility that we saw of a couple of weeks ago that really set this process back dramatically. So we have a bit of a victory there in that the two presidents are communicating. As far as the actual peace agreement or the ceasefire between Russia and Ukraine, both sides are already accusing each other of violating that this morning. So there were attacks allegedly from Russia on Ukrainian energy installations, and Russia says that Ukraine is doing the exact same thing back.
So when Steve Witkoff says he believes that, I think he said to some extent, well, some of these attacks were already happening, or I don't know, I guess the devil and timing is always in the detail, or the devil's in the details. He believes that President Putin is acting in good faith. Your knowledge of President Putin and how he does things, do you think he is?
Well, one of President Trump's predecessors in the White House, when talking about Russia, always said, trust but verify. And, you know, there hasn't been a whole lot of verification going on lately. And what we do know is that President Putin has in the past gone back on his word when it comes to holding off on attacking Ukraine.
Right.
And so with what happened this morning and with the fact that the timing, as you suggest, is still incredibly vague on when this is all going to start and when the ceasefire will kick off, we still don't know, first of all, what President Putin's word is and when or if he'll start to obey it.
So I just want to get your thoughts about where we are, in your view, if this actually is the beginning of the end of the war. You mentioned that both sides are already not agreeing to what had been agreed upon, but you also said that it's good news that the U.S. is speaking to both of these parties. Do you actually think this is the beginning of the end of the war?
It might be. I mean, I think if this is the beginning of the end of the war, it's going to take a lot longer than any of us anticipate and a lot longer than any of the actors in these negotiations are telling us. I mean, we know, look, that the strategic driver for Putin behind all of this is to keep fighting. So when he says that he's engaged in ceasefire negotiations, when he says that he's interested in a ceasefire, he's really not being entirely genuine with his counterparties, because really what Putin wants to do is to continue to press on. He thinks he's winning on the ground in Ukraine. His progress has been a little bit better than previously, and right now there's very little incentive for him to stop.
So that's a perfect place to sort of transition to business in Russia over the last few decades, something that you've been writing about and that you know a lot about. If we were talking to you 3 years ago, we'd be talking to you about all the American businesses that have announced that they've stopped doing business in Russia as a result of Russia's invasion of Ukraine. I think a lot of people then would have thought this is going to have huge economic consequences and effects on the country and might cause Russia to think twice about what it's doing militarily. That obviously didn't happen, right?
Well, exactly right. I mean, if we were talking about this precisely 3 years ago, what we would be talking about is absolute sort of streams of Western executives stampeding towards Moscow's airports, among other places, trying to get out of the country. And this was exactly 3 years ago, a time when international offices, European and American offices, were physically emptying out of expats and of Russian employees who were desperate to leave the country because the full-scale invasion was kicking off. And so if we look at it now, you know, the U.S. business community is looking at the negotiations between Trump and Putin, and they sense that sanctions relief is in the air. And there are active conversations now in the companies that left Russia 3 years ago about going back. Not everyone will do it, but everyone is talking about it.
Yet, you know, you write or you note that in like one generation, we saw Russia open its doors and then close them again. So, I mean, what ultimately rules in Russia? Is it money? Is it business? Is it politics?
Well, you're right. I mean, the last generation in Russia was one of the biggest experiments in global capitalism ever. You had this emerging market opening up during a time when companies were globalizing rapidly, and everyone rushed into Russia following the collapse of the Soviet Union.
Right.
You know, for companies to go back, it is partially all about money, but it's about that and a lot more. It's about a change to the risk-reward equation. And in the 1990s, just about anything that you did in Russia, almost any kind of Western business activity, made money. It was really like, you know, plant any seed and it would grow.
Right.
That is no longer the case. Companies that want to go back to Russia or are thinking about going back are not going back to the Russia of the 1990s, not going back to the real go-go days of the 2000s. It's very different now.
Well, talk to us about this. And this is something Tim and I talked about with Angela Stent, who understands Putin, understands Russia too. And I said, you know, what is today's Russia? What is Putin's Russia? Is it a great power? Is it a great economy? You know, what are their businesses, their alliances? Like, what do we need to know? And some of it I asked facetiously when I said, is it a great economy? But I mean, what is it today?
Well, you know, there were a lot of people, not Angela Stent, who's one of my idols in the field of Soviet and Russian studies from way back in the day. You know, there were people that said that Russia was a gas station with nukes. And, you know, that is a vast underestimation of Russia's role in the global economy. And we understood that when Russian gas and oil and all of that came under sanctions, or oil came under sanctions, and when the Europeans tried to chase gas out of their pipelines. We understood what happened to prices. We also understood what happened on global grain markets after the start of the full-scale invasion. So Russia is a lot more plugged into the global economy than we ever thought, and perhaps even more than we think, particularly in the area of precious metals, rare earth metals, critical minerals. These are places where Russia has significant strategic deposits that are useful not just to Russia, but to everybody else around the world. So, you know, there is reason to go back in. There are companies that are thinking about it, but look, the war lasted a lot longer and is lasting a lot longer than anybody ever thought. And enormous changes have taken place on the ground, politically and economically in Russia. And if you're thinking of about going back, you have to be thinking, well, what kind of Russia is waiting for us?
Well, what did Russian businesses, Charles, do to replace American businesses and Western businesses that left? We all saw stories of McDonald's, for example, pulling out. That was such a prominent example because of what happened when the fall of the Soviet Union happened, and that first McDonald's opened up in Russia. But we saw this sort of Russian version of McDonald's come in. What has happened on the ground since American and Western businesses have left?
Yeah, a lot of different things have happened since Western and American companies left. And that is that you're absolutely right to point out that a number of significant Western brands, including McDonald's, which everybody loves to look at when we're talking about Russia, but other companies like Starbucks, for example, had a massive presence in Russia, and they're gone too. They've been taken over by local Russian owners. They were sold when those two companies decided that they wanted out. And so what those companies have been doing has been winning, growing, and maintaining market share and trying to sort of run businesses. And right now it's very difficult to understand whether the current owners of McDonald's or Starbucks or any of the other companies that left, you know, how keen they are to sell those back to the people that they bought them for just a couple of years ago. The other thing that's happened on the market is that companies from non-sanctioning countries have moved in, and that includes countries like Turkey and China. They've taken over market share. They've moved in, and it's going to be difficult for returning companies to dislodge them.
So it raises the question about initially why the companies left during the invasion. In your view, was it because it was seen as not ethical to do business and support a country that had this invasion? Was it because of American regulations, or was it an actual business decision?
There were a few different decisions. In some cases, sanctions made it illegal to do business in Russia, and there were companies that just had to get out because there was no way that they could transact in Russia at all without violating sanctions. Other companies looked at the reputational risk of doing business in Russia, and you had significant external pressure on these companies saying, why are you still in Russia? You're paying taxes to the Russian government. The Russian government is using that money to buy weapons to kill Ukrainians, so what are you doing there? Companies felt that reputational pressure, and they left. And then there were companies that for whom it was easier to leave because maybe Russia wasn't that big a market, maybe they weren't doing all that well there anyway, and why bother with all of the difficulty of doing business in this kind of environment, and so they also packed up and left.
One of the things I want to ask you, and I thought about this, Charles, we are talking with Charles Hecker, journalist and risk management consultant. His book out this month, Zero Sum, The Arc of International Business in Russia, spending some 4 decades in Russia and the former Soviet Union. You know, I think we think that introduce capitalism, introduce Western businesses, whether it's China, whether it's Russia, that these countries, these places will become liberal democracies. And here we are again seeing that it really doesn't work. So is it not going to work if we continue to, like, what's what's wrong with our thinking, or why is it not working?
One of the lessons that we have to have learned on exiting Russia is that the assumption we made, just as you said, Carol, the assumption that we made on the way in, that engaging with Russia economically and commercially and sending Big Macs to Russia would transform the country somehow into a mirror image of the West, or into at least a sort of liberal democracy that we could get along with. And, I think we've learned over the years, whether we're talking about Russia or we're talking about China, for example, or other countries, that, eating Big Macs doesn't make you a Democrat, little d Democrat. And so, if companies once again go back to Russia and think, look, we're going to be on the ground and we're going to give this a chance, and we think that Russia may reform, that's a mistaken assumption. And, we realize that perhaps a little bit too slowly. I don't want to be too judgmental about our experience in Russia over the past generation, but it was a flawed assumption.
So President Trump seems to want to create economic ties between the U.S. and Russia. Some say, the diplomacy or lack thereof, or whatever you want to call it, that we've had between the U.S. and Russia and President Putin so far has not created a better relationship. So maybe this could. Is that even possible with your knowledge of President Putin, how he runs the country, his type of leadership? I mean, is there some good that could come out of this?
I think President Putin is going to remain resolutely hostile to the West going forward.
United States included.
Yes, absolutely. The West, capital W, bold-faced letters. He is going to remain hostile to the West and the United States, and he will see them as enemy nations. And he will take a very skeptical view towards companies that come from those countries. And so he certainly doesn't believe that allowing Western companies into Russia, or American companies into Russia, is an overwhelming good for the Russian economy, or certainly for the Russian political system. And that's something that companies are going to have to manage and overcome and be extremely acutely aware of if or when they go back in.
Tim, I know you had a quick one last question. Real quick.
Yeah, Charles, would you recommend that companies just don't go back to Russia?
Companies are going to make up their minds about this based on how they view the risk-reward decision. And look, there are companies out there in, for example, the energy sector, in natural resources, in metals and minerals and mining, that have really robust appetites for risk and cast iron stomachs for managing it. They will probably go back, and they're going to do it carefully. They've done this before. They're doing business in places like Iraq right now. So they'll go back to Russia, and we'll see how they survive.
Listen, so love this. Hope we can get you back real soon, because we know that this is going to be certainly an ongoing and kind of story that will probably go on for a while. Charles, thank you so much. Good luck with the book.
It's a pleasure. Thank you.
A pleasure is ours as well. Charles Hecker, journalist, risk management consultant, book just out. It is called Zero Sum, The Arc of International Business in Russia. All right, let's get back to the day on Wall Street. Here is Charlie Keller.
All right, thank you very much. Stocks got a relief rally in the best Fed day since July. Stocks rose, bond yields fell after Fed Chair Jay Powell signaled the Federal Reserve saw no need for drastic action in the face of Donald Trump's trade war and its impact on inflation. The Dow, the S&P, NASDAQ all advanced today. S&P 500 index up 60. That was a gain of 1.1%. So the S&P on this Fed day, 56.75. The Dow up 383, up by about 0.9%. The NASDAQ Composite Index up 246 for NASDAQ. That was a gain of just about 1.4%. 10-year yield 4.24%, with a 2-year currently yielding 3.97%. Spot gold up $10 the ounce, $3,045 on gold. That was a gain of 0.4%. West Texas Intermediate crude oil up 0.5%, $67.74 a barrel. Bitcoin, big move there, up 4.2%, 85,453 on Bitcoin. So it was an up day, a Fed day. Veronica Willis is a global investment strategist at Wells Fargo Investment Institute. And right here on Bloomberg Business Week, she told us hopes for 2 Fed cuts may be overly optimistic.
It's, more realistic to expect maybe 1 cut this year. And I think that the risk is a little bit more on the side that there might not be a cut this year versus 2 or more cuts. So I think it's just another example of the market kind of taking what it wants from what Powell says, taking what it wants from what the Fed has shown us, and hoping for that best case scenario.
Veronica Willis, global investment strategist at Wells Fargo Investment Institute, interviewed right here on Bloomberg Business Week. After earnings, Williams-Sonoma shares down today by 3.5%. After earnings, Signet Jewelers, which is the parent company of Kay, among many other mall staples in terms of jewelry, Signet surged today by 17.3%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
And splashdown, Crew 9 back on Earth.
Yes, indeed, everybody. Yes, those 2 NASA astronauts whose planned short trip to space became one that left them in orbit for 9 months. Yes, you know, they are back on planet Earth. Butch Wilmore and Sonny Williams coming home to a United States, though, that is a bit different, I should say. It's got a new president, a new Republican-controlled Congress, and a world that some would say is being turned upside down by new U.S. policies. Now, those 2 NASA astronauts also returned to Earth in a SpaceX craft, which is, of course, you know, SpaceX, a part of the Elon Musk empire. So, too, is DOGE, the entity that is tasked with an ever-widening mission to seemingly remake the U.S. government, and that includes cuts in spending and in the federal workforce. So we thought it was time to do kind of a check on all things Elon and Tesla and SpaceX and DOGE and more. To do that, we have back with us Bloomberg Business Week columnist Max Chafkin. He is co-host of the Elon Inc. podcast, author of The Contrarian, Peter Thiel, and Silicon Valley's Pursuit of Power. Max is here in our Bloomberg Interactive Broker studio. Of course, Tim out there in our San Francisco bureau. Max, good to have you here. We were trying
going on.
Well, you know, we were thinking about Elon today, and like he's in this kind of funny spot. He finally brings these 2 astronauts that I know NASA doesn't want us to use the word stranded, but we're stranded up in space. They were safe, but SpaceX brings him home. At the same time, you've got a federal judge, ruling that Musk likely exercised unconstitutional power in the Trump administration's efforts to shutter the U.S. agency that manages foreign aid. I mean, there's so much going on, the highs and lows that seem to be Elon. How do you, because you continually have to kind of put it all together, make sense? How do you put it all together?
Well, I think, of course, this SpaceX mission is a demonstration of all that company has achieved. They are the main way that America gets its astronauts to and from, and cargo to and from the International Space Station. There is this competing effort that the Boeing craft that is going slower, and Elon Musk, as you said, stepping in. Now, I think the problem here is Musk, I think in his mind, and when you look at like some of the things he said about what he wants out of the Trump administration, he just sort of expects Trump to essentially give a bunch more contracts to SpaceX. I think in these court rulings and in some of the pushback we're seeing, political pushback, as well as pushback from consumers, like some of these vandalistic acts on Tesla stores and so on, we're seeing that may prove to be more difficult than I think maybe the Elon Musk, super fans would have believed.
What do you mean by that, Max? How is that more difficult?
Well, I think there's a couple of things. One is we're starting to see sustained political opposition, not just to Donald Trump, right, whose poll numbers have dipped a little bit in most polls since he took office, but even more so to Elon Musk. Elon Musk has gone from being a very popular public figure to being an unpopular public figure, even more unpopular than Donald Trump or like a typical Republican politician. And so that is going to be a challenge. That's a challenge because, Democrats and Republicans are consumers, and if people are generally mad at Elon Musk, they may not buy Teslas. We're seeing that show up in some of the Tesla sales data. I think it's also a challenge if we're talking about some sort of effort to hand SpaceX another contract. Now, of course, NASA did use SpaceX to bring these astronauts back, but as you said, Carol, they didn't really have an option. But what Elon Musk is going to be talking about, and is talking about to some extent, are contracts where there are other options. So this rural broadband program where Musk and his supporters would very much like the emphasis to go away from fiber optic to satellite. That is going to have political opposition. We're seeing opposition in Italy, where Giorgia Meloni, who's of course a Musk ally, there's been talk of giving SpaceX, Starlink, the satellite division of SpaceX, a big contract. We're seeing opposition there, and then I think you're even starting to see little hints of opposition to, what you might see as a more transactional thing in the U.S., where if Elon Musk were to get what he wants, he would get like a giant Mars contract. Now, I think that is going to be, as I said, it's going to be difficult. There are going to be senators, congressmen who are in the states where these other legacy aerospace contractors are, who are not going to be happy about that.
There's also business challenges too, Max, and I'm curious about your thoughts on this. We got news this week that Xiaomi is actually raising its target for a number of vehicles that it plans to deliver this year. BYD comes out with this 5-minute charging, essentially equivalent of going into a gas station, filling up your gas tank. Tesla doesn't have that technology. In the US, you can't get these Chinese autos, but around the world, you certainly can. It seems like there's some real business realities that the Tesla empire is running into.
Yes. I mean, we would be talking about these challenges even if the politics were working perfectly for Elon Musk. You talked about China. We've seen Chinese automakers make huge strides. And you're right, Tesla is protected to some extent because these Chinese companies are not in the U.S., but Tesla gets about 40% of its sales from China. So this is like a direct threat to its business. Also, these companies are operating in other regions where Tesla, collects a percentage of its sales. So even today, this is a problem. And then the other thing you're seeing is a lot of these Chinese automakers are offering basically their own versions of what Tesla calls full self-driving. This is an advanced driver assistance software suite, and they're effectively giving this software away. The Tesla bulls had been expecting that they would be able to charge huge sums of money for Tesla full self-driving. Right now, it costs about $100 a month. Now, and when Musk has talked about it, he said it's going to get even more expensive because if you could, take a nap in your car, that would be worth even more. Now, I think there are reasons to be skeptical. I wouldn't, if you're driving down the highway right now, I wouldn't take any sleeping pills and trust the Tesla. But that said, even if that technology were to pan out, even if it were to do exactly what Elon Musk says it's going to do, there are potentially other companies doing the same thing for less money, and that's a challenge.
I feel like the million, billion, trillion-dollar question, though, Max, is there information that Elon Musk is getting working within the government that is going to give him this incredible advantage or access to data? I think about, the AI, startup that he's involved in and like all this stuff. Is there stuff, or do we not even know, that he is getting access that even if he leaves tomorrow, that he has an advantage in some way?
I mean, he has. I think that in theory, yes, AI systems rely on huge sums of data. If Elon Musk were able to funnel a bunch of, if data were to leak from the federal government into Grok, Elon Musk's large language model, that could in theory help Grok. But I think there are a number of reasons that I don't know that that's the most likely scenario or the most concerning scenario. There would be ethical issues, legal issues, issues of personal privacy, and also I just think that the political advantages he has by being close to Trump probably vastly outweigh whatever incremental data. There are a lot of data sets, a lot of financial data sets out there. I do think some of these agencies that are being, as the Trump administration and supporters see it, reformed, as its critics would say, gutted, were agencies that were investigating Elon Musk, were holding Elon Musk companies back. X, Elon Musk's, the new name for Twitter, has been trying to launch these payment services, effectively mobile banking through, the company that you use to send memes. And the CFPB has been one of the barriers there. Like CFPB, has been, it's in the courts now, but the Trump administration is essentially attempting to shut it down. NHTSA, the highway regulators, they have been investigating Tesla. There are ways in which Musk could sort of clear a path in terms of from a regulatory perspective. But again, all these things are going to create political consequences, downstream political consequences, and that those. It's going to be primarily Democrats. That's who we're seeing protesting in front of Tesla stores. But I would not be surprised if you also see some Republicans with concerns about this stuff as well.
Well, it seems like now, Max, the courts are really, as Carol mentioned in our intro, the courts have not reined in, but they've certainly said that some of what Elon Musk has done is not allowed, especially with regard to USAID. There are questions whether or not these employees can actually go back to work, and if they're going to be reinstated full time. We don't know the answer to that yet. But are the courts reining him in?
Yes, the courts are reining in Doge, and or at least maybe creating a situation where what Musk is doing is not going to have a huge long-term effect, or even that it may end up costing more money. Because of course, if you lay a bunch of people off, you spend a bunch of money laying people off, and then you have to spend a bunch of money bringing them back online. That ends up costing more money. So there is a way in which some of this stuff that's working its way through the courts ends up sort of blunting the impact of Doge. I mean, it's important to remember, Musk is not the only actor within the Trump administration or within the Republican Party who's trying to rein in parts of the federal government. And so Trump is trying to do this as well. Congress will certainly, I think, at least attempt to put some of this into law. So there will be, Musk will have some support. It's not just going to be Musk versus the courts.
Should we assume that as long as Elon's deep pockets are around to support the Republicans and Trump's doings, that he's going to stick around? Like, I think there's a lot of discussion about, when does the president get tired of Elon, right?
Yes, that's the conventional wisdom is at some point Trump will get tired of seeing Elon Musk's, face, on TV or newspapers, hearing people talk about it when they should be talking about all the great things he's done, get frustrated, and he'll get sort of iced out. I think that is not very likely, and it's for the exact reason you just said, Carol. Musk is a major donor to the Republican campaign, to Republican campaigns. He will be a major force, by his own account anyway, in the midterm elections, and really he is a very important ally for President Trump, because if Trump is trying to do something and there's opposition from Congress, he has this very, 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 very wealthy friend, Elon Musk, who can fund a primary challenge. The other thing is, we saw this infomercial, at the White House, where Trump, talked about all the wonderful things about Tesla, and in fact bought a Tesla, on the South Lawn of the White House. Really helpful, or potentially very helpful to Tesla. That seemed to be the goal. Around the same time, the New York Times reported that Musk had promised to put $100 million into Trump's own PACs. So Musk is still donating money on top of the roughly $300 million he put into the 2024 cycle. He said he's going to put more into his own PACs. He, in fact, is funding this Wisconsin State Supreme Court race. Right. There are going to be more races, and he's giving Trump money. I mean, he is a very, very important ally. I think the real question is, does Musk get tired of this? Does Musk start to wonder, do I really want to have a day-to-day role, and how much is that day-to-day role hurting my companies? Because you look at the stock price, investors are not super happy.
All right, always a lot going on, and so appreciate it. Keeps us busy. I'm always confused. How many more headlines? Is it Trump versus Elon like we get in any given day? Max Chapkin, thank you so much. Columnist with Bloomberg Businessweek, co-host of the Elon Inc. podcast, which you can find wherever you get your podcast, also on the Bloomberg and at Bloomberg.com. And Max, also the author of The Contrarian, Peter Thiel and Silicon Valley's Pursuit of Power. Max, thank you.
All right, let's take a look at some stocks on the move today. We're joined by Bloomberg News cross-asset reporter Emily Graffeo. Emily, I know you got a little bit of retail on your mind this afternoon. Williams-Sonoma, what's going on with Williams-Sonoma?
Yeah, this is a name that didn't have a great day as a publicly traded company. The shares fell as much as 13%, but they did pair those losses. So the stock only closed down 3%. The earnings were a little bit of a mixed bag. The most recent quarter was pretty good, but they do see their operating margin 17.4% to 17.8%. The estimates were for 18%. So analysts, I guess, were disappointed in that very slight miss, but perhaps became a little bit more complacent with it throughout the day, and that's why we saw the worst of the stock declines erased. It was also interesting to kind of get a read on the consumer in the actual statement that Williams-Sonoma put out. Obviously, they're tapped into what people are buying for their kitchens and homes. The CEO said, despite an uncertain backdrop, we have been and will continue to be focused on returning to growth, enhancing our world-class customer service, and driving earnings. So that kind of line, uncertain backdrop, maybe stood out to me. Maybe Jerome Powell would have agreed with that today.
It's where I get my waffle mix. I'm just going to
Really?
say. But yeah, I do. It's really good waffle mix. Can I just put it out, full transparency? But you know what's interesting though? I was thinking about this, Emily. It's a higher end consumer in general. Like stuff is not
That's right.
inexpensive there.
Yeah, it's like really fancy waffle mix or like fancy jam.
That's all I'm buying. I go in and get my waffle mix and then I'm out. That's it. I'm just going to tell you. Hey, let's talk about Intel. What's going on there?
So that stock was the worst performer in the S&P 500 today. It seems like there was, I guess, some confusion about this chip maker perhaps coordinating with other companies. It was the stock was down as much as 7%. Basically, what had happened was there was a report that TSMC, Taiwan Semiconductor, had pitched NVIDIA, AMD, Broadcom, and Qualcomm about taking stakes in a joint venture to operate Intel factories. So I guess there was some optimism about that. But then today, a TSMC board member dismissed that report about that JV. So the stock is actually still up 20% year to date, which is surprising because it had lagged obviously behind NVIDIA, its biggest competitor. But at least for 2025, the year that's been so far, it is still outperforming the broader indexes and the other chip makers.
It did lose 60% last year. I'm just going to put that out there.
Yeah, that's good context, Carol.
That joint venture, though, I feel like it's been out there, on again, off, I don't know. Just like little pieces have been brewing. So kind of interesting to see the news today.
Okay, Emily, Boeing. It was also one of Carol's movers. What's going on with Boeing?
Tim, did you not listen to me earlier? I guess you didn't listen to me earlier,
I did listen. I knew it was one of your movers, but I want to hear what Emily has to say.
Take it away.
This is another stock that needs that context, that longer term context, because it was up 7% today. It was the best day since July 2023. It was one of the top performers, actually the top performer in the S&P 500, but obviously it's taken a beating. It's in negative territory year to date, not a 12-month basis, but they had a good day today. They had some commentary earlier in the day that their cash outflows are likely to be smaller than forecast this quarter as they stabilize work in factories and clear out inventory of already built jets. And then William Blair, they said that these were positive tariff developments in the company. So at least some of the street was cheering, I guess, this news. So a good day for Boeing, at least if only for today.
Yeah, I know. They're working on it, right? But they've been working on it for a while. So I guess we'll have to wait and see. Great stuff. Couple of the names to keep an eye on, or that we did keep an eye on in the Wednesday trade. Emily, thank you so much. Bloomberg News cross-asset reporter Emily Graffeo. All right, that's going to do it for Tim and me on this Wednesday. When are you coming home?
I'm going to be back in the office next Monday. I got 2 more days out here in San Francisco. Got a couple of good technology shows coming tomorrow, Carol Masser.
Good.
And then we got some great Business Week shows coming tomorrow as well.
We do indeed.
And Friday.
And some really good guests and stuff. A little bit of earnings news and so on. So do not go anywhere. Have a good and safe evening from Tim and me. Balance of Power starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From from Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide. Welcome to Balance of Power. Alongside Joe Matthew, I'm Kayleigh Lyons.
The Fed holds rates steady with its updated forecast signaling stagflation. And Chair Powell seeing a transitory tariff impact. We'll have more former Treasury official Christopher Smart of the Arbroath Group.
President Trump phones Ukrainian President Volodymyr Zelensky, who joins Russia in agreeing to an energy infrastructure ceasefire. General Wesley Clark, former NATO Supreme Allied Commander Europe, will have reaction.
And former DNC chair and Democratic Congresswoman Debbie Wasserman Schultz of Florida will join us later this hour. Her take on growing Democratic calls for new Senate leadership after Senate Minority Leader Chuck Schumer's decision to support Republicans' government funding bill. Thanks for being with us. The late edition of Balance of Power on this Wednesday, Fed Day, and that is right where we start with today's meeting. No change in rates as expected, with policymakers citing uncertainty around the economic outlook, the impact of President Trump's policies on growth. Today, raising estimates for unemployment and penciling in 2 quarter-point cuts this year. In the news conference following the announcement, as you saw and heard live on Bloomberg TV and radio, Fed Chair Jay Powell speaking to the relationship between inflation and tariffs.
It is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Clearly, some of it, a good part of it, is coming from tariffs. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year.
For more, let's turn to Bloomberg's Mike McKee, who was in the room for that press conference. Mike, I think we all could have anticipated we would get a lot of that particular T-word, tariffs. I'm not sure anyone was counting on the T-word transitory making a comeback, but it did.
I wouldn't put too much stock in that. I think it was sort of just something stuck in his head. Historically, tariffs have raised the price level, but it's a one-time thing when you raise the price level. The problem for the Fed is they don't know if Donald Trump is going to raise tariffs on April 2nd, on May 3rd, on July 23rd, or anything like that, because he keeps changing his mind about everything, and he takes tariffs on and he takes tariffs off within the space of a single day sometimes. So they can't really say what the long-term effect is going to be, and basically this central bank is flying blind now. They don't know what's going to happen. Tariffs are not good for the economy. Some of the other policies they're talking about are not good for the economy, but how bad, how they will affect the economy, and whether and what the Fed should do about it, totally unclear.
I had to chuckle when I heard this today, remembering Larry Summers talking to David Weston, compared this short-term pain for long-term gain approach by this White House. He called it the new transitory. So I guess here we are. To your point of flying blind, though, how much progress did Jay Powell make today in calming the waters, calming the markets?
Well, it looks like he calmed the markets, and I think probably the takeaway was he was calm, cool, and collected, and he said, we got this either way, and right now we're in a good spot. We have inflation moving up a little, but it's fairly steady. Unemployment, fairly steady. The economy still showing signs of reasonable growth, even if it's slowing a little bit. No reason to panic. And you can read that how you want on Wall Street, and obviously there are people who are going to read that as, hopefully we get a rate cut soon. But I think it just the idea that the Fed's not panicked has probably been good news today.
Good to have you in Washington. As always, Bloomberg's Mike McKee with us on a Fed Day. As we add the voice now of Christopher Smart, managing partner at the Arbroath Group, former special assistant to the president for international economics. It's great to have you back on Bloomberg TV and radio to pick up on Mike's point here. How long will the Fed be flying blind, and will that last after April 2nd?
Well, I was getting excited that I could get out my Team Transitory T-shirt again until Mike tells me I should move that to the side. But I think the Fed, Jay Powell is the master of understatement when he talks about the difficulty in projecting either growth rates or inflation trajectory for the economy. I think it's going to be increasingly difficult. As Mike pointed out, tariffs in themselves, a one-off adjustment, is a transitory effect. But tariff wars, it's not just the unpredictability on the U.S. side, but it is the response from Canada, China, the European Union that makes it even more unpredictable. So I think what markets are watching ever more intently are the measures of inflation expectations. And right now, the five-year forwards are relatively stable. And I think that underpins a lot of the confidence that you're seeing today in the markets. But I think that's something the Fed's going to be watching very closely.
Well, it was interesting to hear Chairman Powell today throw a little bit of cold water on the notion that we should put too much stock into UMich inflation expectations specifically. But I think a lot of people were looking at the Fed's own inflation expectations in the SEP today in tandem with their lower growth expectations. It caused a lot of people to say the word stagflation, which is actually something we also heard from Heather Boushey, formerly of the Council of Economic Advisors in the Biden White House. This is what she told us earlier.
So now they are still working to get the inflation rate back down to their target rate, and at the same time, the tariffs are likely to raise prices for consumers. But they're also seeing people cutting back. Again, with DOGE, you're seeing these effects on employment. So the word that I think people are going to start wondering about again is this word stagflation that we were all, of course, talking about at the end of the first Trump term. That was the word on everybody's lips. That's where we were concerned about the economy being.
So if it's on everybody's lips, Christopher, is that warranted or overdramatic?
Well, you saw it in the summary of economic projections from the Fed today, right? You saw inflation tick up slightly in their longer-term projections in the next couple of years, and you saw growth come down certainly this year. So I think that is a reasonable scenario going forward. There are lots of uncertainties around any of those assumptions, which I think makes things even more difficult for investors. And to your point about what level of uncertainty or what measures should it be Michigan Fed or other surveys in terms of inflation projections, I think we all just read the news every day and feel like there is very little predictability in U.S. economic policy right now, which is what has been roiling markets.
Christopher, we just heard some comments from Kevin Hassett in the White House driveway as he was talking to reporters a short time ago. Of course, Director NEC asked about this idea of negative market sentiment surrounding the tariff policies, the comments today from Jay Powell. He said he respects the independence of the Fed too much to weigh in and cherry pick the Fed chair's statements. Is that the new relationship now between this White House and the Fed? How would you describe it?
Well, I think that's sort of welcome non-interference from the Trump White House these days. So I think that's probably what we would hope for in terms of non-comment and non-cherry picking. But I'm not sure we're going to expect the president to be restrained in the next weeks or months if the economy does indeed start to slow and he turns his attention to the Fed. And, what seems like a reasonable policy of let's do nothing until we're sure whether the next move should be up or down. I'm not sure the president, will be so restrained in his remarks.
Well, the president didn't seem to be too focused on this particular decision today, at least on his social media feeds. No true social post yet that I'm aware of, Christopher, though we did get, of course, a true social post and other statements from the White House today related to his phone call with Ukrainian President Vladimir Zelensky. When you consider the administration's efforts to reach a ceasefire in that war, what's happening in the Middle East as well, while we factor in all these domestic risks around tariffs and what the economy will look like, what about the geopolitical atmosphere? How does that factor into all of this?
I think it factors in the background. Certainly the path of any kind of war or ceasefire in Ukraine will have bigger implications for Europe, for example, if there is some sort of lowering of energy prices or access to Russian gas in the year or two ahead. Frankly, right now, today is a good day in the sense that both Russia and Ukraine appear to be ratcheting down their level of hostilities one notch in terms of a ceasefire that avoids energy targets. But there's a long way to go to get the two parties to agree to any kind of a longer-term solution. And what you're seeing is an increasing divergence in interests, not just between Ukraine and Russia, but between the U.S. and Europe and Ukraine and Russia. So getting all four of those parties aligned is going to be a tall order for the president. I think those things weigh on investors' minds, but they're still probably secondary to the path ahead for growth and inflation that the Fed has been focused on today.
All right, Christopher Smart, managing partner at the Arbroath Group. Thank you so much for joining us. And
Great
we'll
to be with you.
continue this conversation ahead in the aftermath of Zelensky and President Trump's phone call, the agreement for an energy ceasefire with Russia. We'll have more on that next with retired General Wesley Clark, former NATO Supreme Allied Commander Europe. He'll join us next on Balance of Power on Bloomberg TV and radio.
minerals deal was that first set of framework that you all saw in that very public meeting with President Zelensky and President Trump in the Oval Office. We are now focused on a long-term peace agreement. We've moved beyond just the economic minerals deal framework, and we're looking at a lasting ceasefire. Right now, we're at a partial ceasefire, but again, the president is sending his highly skilled, intelligent, and experienced team to Saudi Arabia later this week to continue fighting for peace in this conflict.
White House Press Secretary Caroline Leavitt earlier today providing an update on efforts to reach a ceasefire in Ukraine in the wake of Russia's invasion. This, of course, comes after President Trump's call with Ukrainian President Volodymyr Zelensky this morning. And joining us now for more here on Bloomberg TV and radio is retired General Wesley Clark, former NATO Supreme Allied Commander, Europe. General, welcome back to Balance of Power. When we consider where this starting place seems to be, a ceasefire on just energy and infrastructure targets specifically, how easily, in your mind, can this be expanded into an actual truce, or is the hard work really just beginning?
I think the hard work is just beginning. This is a ceasefire, if it happens, that's fully in Russia's favor. Ukraine has now acquired the ability through its own efforts to take out Russian oil production facilities. And they've disrupted about a third of Russia's export production, I'm told. And Russia's making about $180 million a day off these exports. So when you disrupt a third of it, you're really cutting at the revenue that Russia needs to keep its economy going and keep the war going. On the other hand, it's springtime in Ukraine, and so Russian attacks on the power plants didn't shut them down over the winter, and now it's spring. And meanwhile, Russia's continuing its grinding offensive on the ground, where Ukrainian forces are suffering from shortages of ammunition and other things, and the lingering effects of the American cutoff, even the cutoff that was a year ago for 6 months in 2024 has had an impact on the supply chain. So look, thus far, this is all in Russia's favor.
You can play this a lot of different ways here, General. The fact that Vladimir Putin did not accept a ceasefire, the fact that Donald Trump has not been able to finish this in his first day in office as he projected and promised on the campaign trail. Does he deserve credit, though, for maintaining the flow of U.S. aid to Ukraine?
Well, we don't know how much is getting in there, but yes, and the intelligence is also very important. And so far as we know, that intelligence is still going on.
Well, and as we consider whether or not that's going to continue, we understand one of the conditions Russia has to reach an absolute ceasefire is it wants the U.S. to provide no more aid to Ukraine. When we consider that, the prospect of a peacekeeping force in order to maintain the actual truce, if indeed it can be reached, is what Russia is asking for realistic? What kind of compromise do you see?
It's certainly realistic for Russia to ask for it. It's not realistic for Ukraine to accept it. And information is the lifeblood of a ceasefire, of a peace agreement. Information on both sides. Russia has it. There's no way to shut it off to Russia. Russia's spy satellites are up there. They have them. Ukraine won't have it unless the United States provides it. And what happened in the Kursk salient is a good example of what happens when you turn off the intelligence. Russia pulled forces out quickly, massed against the Kursk salient, and overran it. And that was during the few days in which the United States had blinded Ukraine, essentially, on what was going on behind the lines. So got to have that intelligence flow, and it can't be cut off if you want a stable and sustainable peace.
General, I want your take on the readout that we got today from the White House, knowing that President Trump had said just last week on Air Force One that this call with Vladimir Putin was about divvying up land, dividing land, and even power plants. Those were the two things he suggested they would discuss. And, of course, here we are with this energy infrastructure ceasefire at hand. But they said in the readout that President Trump discussed Ukraine's electrical supply, suggesting the United States could be helpful in running those plants. Didn't mention any specifically like Zaporizhia, but said American ownership of those plants would be the best protection for the infrastructure and support of the Ukrainian energy infrastructure. What does that mean exactly? Is that the security guarantee that this White House puts forward? And are we slouching into occupation, General?
It might be considered the security guarantee. But look, those are old, what we consider obsolescent nuclear plants. We didn't design those plants. They're not our plants. We can't just transplant people over there and say, hey, by the way, this is the GE design, go after it. It isn't. But yes, we could learn to take care of those plants. Now, Ukraine can take care of those plants as well. Zaporizhia, the plant's been partially occupied by the Russians. They've threatened to damage it and destroy it at various times. It wouldn't be such a bad thing if the United States says, well, now you can't touch it because we're in it. Maybe it's a way of getting a creeping cessation of hostilities. But it's also a way of just postponing the really tough discussion of telling Mr. Putin, stop, you're the aggressor, pull out, return the abducted children, pay the reparations, and let's get on with the global affairs. You can't just wash this, you just can't wash it away. He has to take the burden of guilt for the aggression. He started the war. It's easy for him to stop it. All he has to say is stop.
General, we only have a minute left, but we saw reporting from NBC yesterday that the U.S. is considering giving up control of the position of NATO Supreme Allied Commander Europe. You, of course, yourself held that position. Is it vital that it stays in U.S. hands, that an American serve that role?
It is the critical linkage between the United States and Europe militarily. It serves as a deterrent purpose. It also serves a diplomatic purpose. And without it, the U.S. is decoupled from Europe. Nothing would make the Kremlin happier than for the United States to give up that position. But I've been told privately that that discussion floated and it's been squashed. I hope that's correct.
Retired General Wesley Clark, it's great to have you back, sir. Former NATO Supreme Allied Commander Europe, we thank you for the insights. Coming up, Democrats strategy.